Welcome to the European Market Open, everyone. A minute to go until the start of cash equity trading. I'm Francine Lacqua in London with Tom McKenzie.
And here are your top stories. Bear scare, US stocks crater. Why $3 trillion. The sell-off continues in Asia, but European futures hold steady. The hawks fly in Frankfurt. Austria's Robert Holzmann says the ECB could decide on a rate hike next month, with other governing council members pushing for July. And Chelsea is close to signing a sale agreement with a group led by former Guggenheim Partners president Todd Bailey. A deal could be reached today, according to Bloomberg reporting.
Tom, let's take a minute to look at the futures, but actually also think about the close that we had yesterday in the U.S. So this is what we're seeing in futures yesterday, the bloodbath that we saw, of course, on the NASDAQ and the S&P. And this is almost like a delayed reaction to some of the inflationary pressures. There's a brilliant piece by John Authers that talks about the nervous system of the Brontosaurus, that it takes time when he gets his tail bits to go into his small brain.
Those dinosaur analogies are always good. I think Francine Lacqua called this on Wednesday in our conversation with UBS's Paul Donovan. You said the boomers don't know how to trade in an environment of high inflation and tightening central banks. And that's arguably part of the mix, what you saw yesterday in terms of that brutal sell-off, the volatility, the uncertainty, the fear in these markets. A bear rally is how some were describing the moves that we saw on the back of the Fed decision. And then, of course, that pronounced sell-off yesterday. And as Francine was saying, particularly notable within the NASDAQ and the pricier sections of the tech sector. You saw the 10-year yield, and we'll touch on this shortly, rising above 3%. That readjustment again. And the Bank of England and the Governor, Andrew Bailey, coming and suggesting, look, a recession could be on the cards for the UK. Stagflation risks in the Eurozone, all of that in the mix. In terms of how this is playing out then into the European markets, the Spanish IBEX currently down 0.8% or 64 points. The French CAC 40 lower by 0.7%. In Germany, a little less bad, but still down 0.5%. And we know that Maria today is on the ground, watching what happens in Salzburg and trying to pass where the ECB is heading as that debate continues amongst officials there. The hawks arguably in the ascendancy. Let's move it on and see how things are playing out then as other assets adjust to that brutal sell-off, both in bonds and equities yesterday. Also crypto taking a hit as well. The future stateside pointing to losses of 0.3%. The US 10-year now comfortably above that 3% in terms of the yield, just a move up of a little under 2 basis points in today's session, but a marked move, of course, yesterday. Do you hold about 3% on that 10-year yield? It's worth noting when it comes to the Eurozone, the spread between the Italian benchmark 10-year and the German benchmark is now around 200 basis points. 250 is seen as a danger zone by some watching that spread divergence. In terms of the Bloomberg Dollar Index, again, the Bloomberg Dollar Index is at a 2-year high, and you're seeing further gains of 0.4%. And Bitcoin was crushed yesterday as well, currently trading at 36,370, down 0.2% after dropping almost double digits, around 10% in the session yesterday. As part of that risk-off move, Francine.
Yeah, the yield between Germany and Italy is extremely important because it's also the two countries, Tom, of course, that rely the most on Russian gas and oil. Now, this is a picture for the sectors, a lot of pressure overall. Now, there are a couple of stocks that are better than expected, but overall, out of the 19 groups that make up our sector watch in Europe, all of them are down. You have travel and leisure down some 1.5%, technology, the second biggest faller, and then you have energy down 0.2%. Now, if you look at the differential, of course, what's happening between the US and Europe, you could argue that valuations in Europe have been a lot more depressed because of that proximity to Russia, which is why we're not seeing a correction like we did in the US yesterday.
A couple of macro stories tying into the individual corporates that we're looking at today. You've got the pandemic, post-pandemic moves around the airlines, IAG. I'll just break that down shortly. Adidas and what's happening with the China story, and then ING and their exposure to Russia. So IAG, of course, the airlines group, look at that, being hammered more than 6% after their losses for the quarter came in above the expectations. They do say in the second quarter they expect to return to profitability, but clearly underscoring the struggles of the airline industry, readjusting post-pandemic. Adidas pointing to softer demand out of China. That is a concern. They're hitting the stock by 4%. And ING, their exposure to Russia, they're taking a hit on this and having to put more cash aside as well in case there is further downside in terms of that exposure as they unwind their business in Russia. Down 0.7% for the Dutch lender. Let's get over now to Fran. Well, you're going to link over to Mark.
Yeah, well, let's go over to our managing editor, Mark Cudmore. He's been watching the markets. Mark, great to have you back. You're looking at sell-off in stocks and bonds.
Yeah, good morning, Francine. A lot of angst in markets this week. How unprecedented in the market action this year? Well, it's an extremely bad year and an extremely rare year in markets. It's not just us being dramatic on TV. This is the annual returns of stocks and bonds in the US going back at the last 49 years. That's as long as we have history for the Bloomberg US Treasury Index. So going back to 1973, the blue bars are the annual returns of the S&P 500. The yellow bars are the Bloomberg US Treasury Index. And only 1 year in the past 49 have both been down in a year. That was back in 1994 when the Fed really shocked markets with its aggressive action. But by the end of the year, bonds recovered a lot of their losses. And of course, stocks rallied again because of that. This year, we're seeing both stocks and bonds down a massive amount. And we're only 4 months into the year. Now, one way of looking at it positively is only 4 months into the year, maybe they could bounce a lot from here. But given that the Fed, we know are going to hike rates aggressively again, we know they're going to tighten financial conditions, I'm not sure whether the outlook is looking particularly positive for other buying of stocks. So this is already pretty unprecedented. And it looks like the outlook for both could be set to get worse in the next kind of 8 months of this year.
Okay, Bloomberg MLive managing editor Mark Cudmore on the moves that we're seeing in terms of sell-offs, combined sell-offs in bonds and equities. Thank you. And just a day after notching the biggest rally in 2 years, the S&P 500 tumbled yesterday with 95% of its companies moving lower. Traders expressed their concerns that officials could struggle to fight persistently high inflation amid the lingering threats of a recession.
This is not a good day. This is not a good year.
We are already pretty firmly in a big bear market.
At the end of the day, it's about inflation.
I think that the market is trying to determine what is the most important factor going forward. So for the Fed, it's very clear. They are a single mandate Fed right now. They are only focused on inflation, and they're telling us that.
I believe the market's going to go at least 50% below its peak.
We think things are overdone. You've gotten rid of some of the excesses, and the underlying fundamentals are still relatively good for now.
Okay, some of the market reaction there, some of the commentary reaction to what we saw in the markets. Let's get into the key drivers then with our MLive editor, Eddie van der Velde. Eddie, what do the moves of the last 48 hours tell you about the psychology of these markets?
Yeah, absolutely. You know what? I think there's a lot of more nervousness just seeping into the market. We can see that everywhere. And, you know, I think that chart that Mark highlighted a minute ago that shows us that there's a drawdown across the 60-40 portfolio. And that's going to be the challenge this year. I think that investors are realizing that they will not be able to be passive this year. They will not just be able to buy the indexes. They will have to look for active management. They will have to look, you know, for that pockets of outperformance. They will have to, you know, be smarter than just buying tech, and buying momentum all the time, because the momentum is turning lower, and they will,
like,
pardon me,
actually work for their fees. That's a novel idea.
Well, absolutely. I think it's shocking. It's shocking, but I think that's what we're going to see this year. I think people who actually dig down into company fundamentals, I think they're going to outperform, because there are still pockets here that, you know, where you can see companies doing well, and we saw that in earnings season. But there's a lot of nervousness about rates and about Chinese growth, and I think those two things together, even with European growth, and then spilling over into the US. I think taken together, I think there's a lot of nervousness about just buying indexes.
Eddie, so we're seeing a surge in credit default swaps. This points to more difficult times. We're seeing also the bridge between, or the gap between, Italian bonds and German bonds, of course, widen. Are we going to start pricing in a recession in markets?
You know, I think markets definitely are concerned about the recession. I think the equity market is still a little bit behind the curve on fully pricing in a full-blown recession, particularly in the US. But we are getting there, and I think there's good reason to, because as it's very hard for the Fed to hike rates. At this point in the cycle, having had so much froth in the system without triggering some sort of recessionary event.
Eddie, you're an expert on all things crypto. What happens to BTC? I mean, Bitcoin hammered about 10% in the trading session yesterday. Does this risk-off move that we've seen in terms of the correlation between Bitcoin and the equity markets, does that continue to hold up, or does it break down at some point?
Absolutely, Tom. You know what? I think crypto at the moment it's a bit of a perfect storm. We're going to see crypto retreat on the back of a weaker Nasdaq. The higher rates is bad for crypto at the moment, and at the same time, you're in a bit of a dead spot in the crypto cycle. We're not at a halving. There's no particular reason to see massive inflows at this moment in time. So crypto is a little bit probably at a bit of a weak point. But having said that, I think the crypto bulls at this moment in time will be quite happy with where the prices are sitting, given everything that's happening. Yes, we had a sell-off yesterday, but crypto is volatile. I think they'll be happy if prices stay above this sort of even 25,000 level. I think they'll be happy with the gains they made over the last couple of years.
Eddie, what's the thing that actually makes you worry? I don't know if there's a canary in the coal mine that we should be watching out for. I don't know what crypto also plays in this, but it feels like there are alarm signals that we should be paying more attention to.
Yeah, so I think the really big one at the moment for the Fed and for others. I mean, jobs growth is still strong, and that's probably going to continue. We're probably going to see a little bit of that coming off. So the jobs numbers today will be important. Participation rate, all of those things we'll be watching. But the really key one for me is house prices, and that comes with a bit of a delay, frankly. But I think as long as as house prices stay strong, and they have been, then I think we can say that the consumer is strong and that the economy is holding up, because frankly that's what most people care about.
Yeah, some metrics you've seen, some house prices, we know that mortgage rates have gone up in the US, some house prices have come a little softer. When it comes to the jobs, and you talked about this, non-farm payrolls, we've got the number, the forecast are for 380,000, Eddie. What for you is going to be key within that mix? Is it participation? Is it wage growth? What are you looking for?
Well, for the moment, it's wage growth and participation. Those are the two things that you mentioned. I think just wage growth, we should start to see it come down. If it doesn't come down, then what is the Fed doing? Why are we doing this? Why are we squeezing the economy if wages aren't coming down? But I think participation rate is still quite low, and if the participation rate starts picking up, which is a hard thing to do because a lot of the people who left the workforce have been people who were older during the pandemic and decided they're not coming back. But if we start seeing that come back, then we can see we can see the pressure on companies to hire workers coming down without too much wage pressure, and I think that would be the golden ticket for this economy. So that's what I'm hoping for.
Eddie, thank you so much. Bloomberg's MLive editor there, Eddie van der Walt, on all of the market action. Now, coming up, as the EU looks to wean itself off Russian crude, we'll dive into how the region will manage the European Commissioner for Budget and Administration. That interview is coming up shortly, and this is Bloomberg.
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
But ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. The place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
Welcome back to the Open. We are 40 minutes into your European trading day. You're seeing losses of around 0.7% across the benchmark here in Europe after a brutal day of selling. Risk-off moves over on Wall Street. Losses of more than 3% on the S&P 500, almost 5% losses across the Nasdaq. Every single sector here in Europe is lower, apart from energy, which is up 0.6%. Worth noting that in terms of the bond markets, and you saw that yield on the US 10-year above 3% yesterday. When it comes to the Eurozone, the Italian-German spread currently above 200 basis points. Francine.
Now, the European Union, Tom, plans to ban Russian crude oil over the next 6 months and refined fuels by the end of the year as part of a 6th round of sanctions on Russia. Now, how will the plan affect the economies of the region? To answer that question and many others, we go now to Salzburg, where our Europe correspondent Maria Tadeo is joined by Commissioner. Maria, over to you.
Yes, Francine, thank you very much. And we are here in beautiful Salzburg. We are joined now by Johannes Hahn, who, of course, is the budget commissioner for the European Commission. And, you know, this is a beautiful scenery, but I wonder when it comes to the economy, is it that beautiful? Do you worry about the European economy in the context of all this uncertainty?
I think we are all concerned around the globe about the economy, but in general, we have seen that we recovered from COVID. Of course, the current war of aggression in Ukraine has slowed down this recovery, but nevertheless, we are rather confident.
And sir, I have to ask you though, there's some out there that say ultimately a recession in Europe is going to happen, perhaps even a period of stagflation, very little growth, a lot of inflation. Can you avoid the recession, the stagflation word? I know it's almost like a word you can't say in public right now, but is that something that you fear potentially could happen, or can you salvage this economy?
Not even in secret, I would say it, because I'm confident that there will not be any kind of recession and even not stagflation, because there is such a strong economy. I mean, if you look at the labor market in Europe, we are lack of labor forces, etc. So I think we have full order books. We face problems in the supply chain, in the global supply chain. That's an issue, and of course, that the war is affecting us. There's a surge of energy prices, etc. But in principle, I think we have taken the right measures, addressing them already at the beginning of our mandate to invest in the green transition, in digitalization, and unfortunately, the war has confirmed the necessity to invest and even to accelerate the transition.
So I guess what you're seeing is that investors, when they look at Europe, they have to make a difference between the core factors of the European economy and everything that's external.
Exactly. And I mean, if I look at so to say, the reaction to our issuance program, this is exactly what the market confirms.
And I'm going to ask you about the issuance program. Of course, you're leading that, but I also have to ask you about the inflation, because you mentioned that too. I mean, we're seeing that everywhere. The food prices, the petrol prices, your bills. I know I pay more than I did a year ago myself. I'm sure you do too. But I wonder, And not to get into the details of the European Central Bank, I know you don't want to comment on the monetary policy, but do you have trust and faith in the ECB that they can actually get a hold of this?
Well, look, I have every trust in the ECB because it's not only one person being there in the board, it's a group of persons, different backgrounds, of course. The European economy is fragmented, but at the end of the day, I think they will find a proper solution to assist in the further recovery.
And you're confident, I guess, that this inflationary spiral that we're seeing, you have the tools to bring it down, because when you look at the figures, however, I mean, it just keeps going up every month.
Yeah, I mean, they will certainly take the necessary decisions. I don't want to make any further comments. It's very sensitive, but I have confidence that they will take the right decisions.
But you say you have confidence in them. And Mr. Hahn, I have to ask you also about, this program, the EU Next Generation. I mean, we all remember that summit. It was 5 days, no sleep, finally came about, and then you've started to issue. I wonder, however, it was very successful at the beginning, but given all this uncertainty, do you still see the same appetite for investors? Do they find European debt and bonds still attractive, or actually are they taking a step back to reevaluate?
No, quite the opposite. I think we had a green bond issuance in March, so after the beginning of the war in Ukraine, and we raised 6 billion. But the order book was 78, so they're
still buying into this thing, even after the war.
Even after the war, there is a demand because they more than ever consider the euro as a safe asset, and I think, unfortunately, but fortunately for us, it has triggered additional, so to say, confidence in our currency.
And, just as a final question, I do wonder, all of this is happening and has been successful because the EU, funnily enough, has been very united since the pandemic happened. We've seen your commission, but everyone else, every country, the 27 working together. However, I have to ask you about Viktor Orban. Many look at him and they look at, well, the bad boy of European politics. Today, once again, he's saying these sanctions, this new package on oil, I'm not going to prove it. Can the EU continue to hold that unity?
Well, at the end of the day, we always find a good compromise, and I'm also confident here. Okay, we know Viktor Orban, but I am convinced.
When you say we know Viktor Orban, what do you mean?
But I'm definitely convinced he will not be a spoiler. He understands what has to be done, and of course, it's always important to calibrate things right, to anticipate the different needs and challenges member states facing. But at the end of the day, we have shown 5 times when adopting sanctions that Europe is and stays and will be also in the future united. So it will also be the case this time.
So this package, the 6th one, you're confident that just like it happened with the 5 previous ones, this will be approved? I mean, you don't see this unity breaking and this decision not happening
No, I think everybody understands how serious the situation is, that the Ukrainians are also defending our way of life, our values, and that's why we have to assist them.
Yeah, of course, and when we think about the people of Ukraine, of course, every day and everything that they've gone through. So, Commissioner Hans, thank you so much. Beautiful seeing this palace. Maybe we stay a little longer if you allow us, but...
Definitely, I'm around.
Well, thank you very much for that. And Francine, that was Commissioner Johannes Hahn, of course, at this conference, Global Europe. It's the first edition here. A lot of speakers that we'll be paying attention to. And in particular, I want to hear from Olli Rehn, this conversation about rate hike. Is it June or July, perhaps? Tom?
Yeah, quite frankly, I don't know what I'm more interested in now. It's the garden behind you, whether you should do a walk and talk or Olli Rehn. But no, that was a road trip. Let's set up the road trip. That was a great conversation, Maria.
It's a tough sell.
Interesting, of course. Yeah, it's a tough sell, isn't it? The European Commissioner there, not overly concerned about recession or stagflation in the Eurozone. Coming up, China has ordered central government agencies to replace foreign-branded personal computers with domestic alternatives. We'll have more on that story later in the show. This is Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Welcome back to the Open, everyone. 24 minutes into European trading day, and you can see we're seeing a little bit of pressure. Of course, some of these stocks are falling. Bonds are also falling on these inflation concerns, but really nothing like we saw in the U.S., where you had lost about 3, even 4% for some of the indices. Treasuries extending a tumble that's lifted the U.S. 10-year past a 3% the dollar gauge near 2-year high. So that's a short wrap-up of the markets. Now let's get straight to the Bloomberg Business Flash. Here's Laura Wright. Hi, Laura.
Hi, Francine. ING has reported first quarter profit that missed analyst estimates after the bank set aside more than expected in order to cover the cost of loans going toward Russia's invasion of Ukraine. The biggest Dutch lender put aside 834 million euros related to its Russia exposure. The U.S. Federal Trade Commission is said to be reviewing Elon Musk's $44 billion Twitter takeover, setting up a deadline in the next month for the agency to decide whether to conduct an in-depth review of the transaction. Under U.S. merger law, Musk is required to notify the FTC of the transaction and wait at least 30 days before closing to allow an investigation into potential antitrust concerns. Peloton is said to be exploring a sale of a sizable minority stake to shore up business as the company's stock continues to sink. The hope is to find a big-name corporation or private equity firm that can help validate the business with its investment. Peloton's value has plummeted from its pandemic highs. That's the Bloomberg Business Flash. Tom, Francine.
Laura Wright, thank you very much indeed. Let's quickly check in on those bond markets. Then Francine mentioned the fact that there is a continued sell-off, particularly around US Treasuries. You're seeing that 306 now on the US 10-year, currently up just over 2 basis points. But in the Eurozone, that spread between the Italian and the German is in focus, a full 200 basis points. 250 is seen as a danger zone, 300 basis points seen as making the front pages in Rome. Keep across that one for you. Plenty more coming up. This is Bloomberg.
It's almost the end of the year, but Bali is still quiet and empty. I am here in Kuta Legian, one of the main walking streets here that is used to be a tourist spot for beach, dining, shopping, but many shops here are still closed. Most of the outlets are either for rent or for sale as they have run out of business.
Saya kerjanya di sini udah lama, udah ada 10 tahunan di sini kerja. Masih sepi sih, nggak kayak dulu. Kalau dulu kan rame, sekarang ya ada, 1-2 itu ada. Tapi nggak kayak dulu, kalau dulu rame sekali. Sekarang paling dapat jualan ya 100, 120 gitu. 200 ya. Kalau dulu sih ya nyampe dah 1 juta, 1,5 tuh nyampe dapat jualan. Bisa sampai 2 juta dulu. Sekarang nggak pernah lagi dapat segitu. Sama aja. Belum ada turis ke Bali. Masih ya domestik aja.
While Bali has reopened its borders for foreign tourists since October, they're still not coming in. Many international airlines are yet to reinstate their direct flight to the island. Balinese people here really hope they can see more people from Australia, China, and Europe to come visit next year.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
Welcome back to The Open, everyone. 30 minutes into the European trading day, and here are your top stories. Bear scare. U.S. stocks crater, wiping out $1.3 trillion. The sell-off continues in Asia and Europe. The hawks fly in Frankfurt. Austria's Robert Holzmann says the ECB could decide on a rate hike next month, with other governing council members pushing for July. And Chelsea is close to signing a sale agreement with a group led by former Guggenheim Partners president Todd Boehly. A deal could be reached today. That's according to our very own Bloomberg reporting. Tom, we look at the markets, but of course Chelsea's also my team, so I could be a little bit distracted.
Which I have no sympathy whatsoever.
I know, no one does. It's just me and Lucy, the floor manager. We're like arch fans. When you look at the markets, it was a bloodbath yesterday, but again, it seems like it's a delayed reaction to inflation.
A delayed reaction. There was that focus on the 75 basis points and the fact that seemed to be taken off the table by Jay Powell. Then, as you say, markets and investors reacting and digesting what was coming out of that central bank. The BOE as well, pointing to a potential recession here in the UK, double-digit inflation of 10%. The FTSE 100 currently down 0.6%. It's pretty grim reading across the front pages today when it comes to that warning from the Bank of England. Across the benchmark here in Europe, losses now 1%, so they've become more pronounced just in the last 30 minutes or so. Again, and the tailwinds from Wall Street, where you saw very heavy losses, more than 3% across the S&P 500, close to 5% off the NASDAQ, and it was a grim session as well, apart from Japan, across the Asian space, particularly on mainland China, and then a tech sell-off when it comes to those Chinese stocks listed in Hong Kong. The DAX down 130 points, 0.9%. Let's switch on and see how things are playing out then sector by sector on a risk-off day once again. By the way, worth mentioning that there is a bit of a move higher as well in terms of yields across US Treasuries after they crossed above 3%, currently around 3.06 the last time I looked on the US 10-year. The one sector remains in the green on the back of slightly higher oil prices, which are about 0.7%. Energy, that sector gaining 0.8%. Every other sector is in the red, led by consumer products, technology and media. You can see consumer products down at 2% 30 minutes into today's trading day. Francine.
Now, stocks and bonds under pressure this morning as inflation, rising borrowing costs, and China's COVID lockdowns depressed sentiment. U.S. markets plunged yesterday, wiping out $1.3 billion in value. Now, we heard from the former Atlantic Fed President Dennis Lockhart following the rate hike.
They're now catching up. Having said that, I think we just have to watch how this economy evolves, and we're already seeing some signs of the labor market that's slowing a bit, so that could take some of the edge off of wage increases, which would have beneficial effect on the inflation numbers. So it's a wait-and-see situation as far as I'm concerned.
I mean, there's so much going on when it comes to inflation. Delayed reaction. One of my favorite pieces, also I'm a big dinosaur fan, thanks to the 7-year-old, is the Brontosaurus. I mean, they were so large and they had a tiny brain. And so if somebody bit their tail, the nervous system would take a long time to go to the brain. I'm not saying the markets have a tiny brain, but there's a delayed reaction.
Well, there's that delayed reaction. That John Author's just beautiful analogy there. I saw the headline of the Brontosaurus, but I hadn't seen the detailed anatomy that you've drawn out for us. The jobs market also, of course, in focus stateside today with the non-farm payrolls The estimates for being at 380,000, looking at wage growth and participation. Francine.
I feel there's a bit of a natural history museum side to this fixed income. Joining us now, Stephen Major. He's Global Head of Fixed Income Research at HSBC. Stephen, so good to see you in the studio. First of all, you're in London. Just looking at the bond route overall, what's going on in the markets? And good morning.
Good morning, great to see you, and thanks for the dinosaur intro.
Analogy.
I'm waiting for some remark.
Stephen Major is no dinosaur. Let's just get the strap on the screen now. Yeah.
It depends on what I say, doesn't it? I could be accused of being a dinosaur because I've been tending to stick.
Because you know about inflation.
Well, I stick with the view. As well. The thing is that it requires someone who's been working for a few decades to remember inflation. I can't promise that I really do, to tell you the truth. So there's a different mindset that's needed to trade a market like this, because we are clearly in a very inflationary time period, and the hawkish response is only just coming through. So the behavior of markets, and therefore investors, is different to what most people who are trading today would have experienced. That is true. So I think the dinosaur analogy has some merit.
How much has been priced in at this point into the bond markets? How much more is there to go?
Well, you can see in the US above 3% is now in the yields, and it's in the forwards.
Is that the floor now, do you think?
Well, I think the floor is important because it keeps going up. And so for me, trying to put a forecast around all of this, the floor for yields is higher, and it makes it untenable to expect yields to be lower anytime soon, because it's impossible to imagine yields falling whilst the central bank's hiking in the early stages. So we need to be somewhere towards the second half of the tightening phase, and we're very much in the first half. So that puts the floor under yields. I think that's quite right. But I've thought of this as a game of two halves. We're still in the first half. In fact, if it was a game of football, we've only played 30 minutes, right? So we're still in the first half. Central banks might be hawkish now, but they could easily become dovish in the second half. So things could change.
So when's the second half? Early 2023 when this plays out? Or are you talking about, an end to the war in Ukraine?
We're talking about the Fed being at 2% by July. So that's 250s, right? The Bank of England could be 6 months in front of the Fed. So maybe there's a read across there. So it looks like the midpoint. And then there's Jackson Hole coming in August. There's a chance for some kind of set piece. So the data is already softening. And I imagine that the market's going to look completely different in the second half as economists revise down their growth numbers. And presumably inflation is coming off. I'm frightened to say that too loudly because we've been stung by this already. We're all waiting for inflation to fall. The danger is it doesn't. But I think that there's a very strong base effect, and we should expect a few lower prints coming up.
Stephen, what's the intersection between rate hikes and quantitative tightening?
Well, I don't think QT matters so much to government bonds if it's of the passive variety. The active variety, whereby the central bank actually sells bonds into the street, we're going to find out, and the Bank of England is going to start the consultation on this. But presumably markets move in advance of the news, and so it should be largely absorbed. I think it's more important for risky assets, and we've already seen how equities have been hit by a tightening of financial conditions. Maybe the war in Ukraine is one of those drivers, but it could also be the fear of QT, because it is true that equities went up from March 2020 onwards during the massive QE. So if we move into the reverse, it could be that risk assets still have to reprice.
So Steve, what would you buy in treasuries right now, if anything?
Well, if I spoke to my colleagues, they'd say don't touch anything. And most of my colleagues are very worried about the momentum, and I think that investors don't want to try and catch a falling knife. I think the longer end, the 30-year, is now starting to find some kind of bite. And when you see yields above 3%, it becomes compelling for the longer-term investors who are going to switch from equities. So think about the pension funds and insurance companies, etc.
Japanese investors, are they going to come back in at this point?
Yeah, well, everyone uses that one on the assumption that yen rates stay where they are. then that's a reasonable idea. And from a currency perspective, don't forget, any Japanese-based investor who bought dollars has done very well on the currency side. That will at least have offset the loss on the bonds. But I think globally is the right way to think on this, because the Fed and the Bank of England are not acting in isolation. What's happening in China? There's a weaker outlook there. How far can rates go in Europe? And so the global picture, I think, is relatively benign for rates. And I don't think the US can break away from that so much.
Stephen Major, we're very pleased to have you in the studio on today in particular. It's always good to have you in studio, but today in particular seems very, very salient indeed.
What a day.
And we'll get more of your views.
Major
Absolutely,
day.
what a day. There we go, that's another strap for us. Not a dinosaur, and a major day. We'll get your views on the BOE, ECB, and where to position credit shortly in the next few minutes. Let's get to the Bloomberg First Word News now with Laura Wright. Laura.
Thanks, Tom. Chelsea Football Club is close to signing a sale agreement with a group led by former Guggenheim Partners president Todd Boehly. Sources say Boehly's consortium could reach an agreement as soon as Friday with Chelsea and its owner, the sanctioned Russian oligarch Roman Abramovich. A deal would end a weeks-long bidding process for one of the biggest English football clubs. The US Federal Trade Commission is said to be reviewing Elon Musk's $44 billion Twitter takeover, setting up a deadline in the next month for the agency to decide whether to conduct an in-depth review of the transaction. Under US merger law, Musk is required to notify the FTC of the transaction and wait at least 30 days before closing to allow an investigation into potential antitrust concerns. OPEC and its allies are sticking with their standard small monthly production increase in the face of tightening global markets. International consumers have been calling on Saudi Arabia and its partners to fill the gap left by a potential EU ban on Russian oil. The group's latest brief meeting rubber-stamped another 432,000 barrels a day increase for June. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. This is Bloomberg. Tom Francine.
Laura, thank you so much. I can't wait, actually, to also have a bit of football chat with our Stephen Major. Coming up, the Bank of England Governor, Andrew Bailey, paints a gloomy outlook for the UK economy as he says growth is expected to slow sharply. We'll get Stephen Major's views on that as well. This is Bloomberg.
About what they call black soot caused by the manufacturing and consumption of these fuel products in the illegal refineries.
Oil theft, known as bunkering, and the refining of its spoils is worsening the damage from decades of fossil fuel exploitation, creating one of the world's most severe ecological disasters.
Our sacred forests, our homes have to give way to oil wells, and no one gets much benefit.
Imagine a resident of Port Harcourt who inhales this soot every second in 24 hours, 7 days a week, 30 days in the month, and for years now, we are dying slowly but surely, and our lifespan is reducing every day.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Welcome back to the Open. The Bank of England issued the gloomiest outlook of any major central bank this year as it raised its key rate. That was yesterday, of course. Governor Andrew Bailey is warning Britain to brace for double-digit inflation and a prolonged period of stagnation or even recession.
We think that a lot of the work in terms of the cure is going to be done by the fact that we are experiencing a historically large shock to real incomes in this country coming from outside the country. So it's a terms of trade shock in that sense. Import prices are rising. That's predominantly energy, food, and some core goods.
Okay, still with us is Stephen Major, Global Head of Fixed Income Research at HSBC, listening into the Bank of England Governor, of course, Andrew Bailey, speaking to Guy Johnson yesterday. How are you thinking about the trajectory of the economy then, as the BOE wrestles with both inflation and a slowdown in terms of growth? Is stagflation now one of those, a base case for you?
I'm not sure whether he's throwing the kitchen sink at it, but he was refreshingly candid, because here you've got a central banker openly talking about recession, stagflation risk, and everyone is now trying to pass every word and every piece of data because maybe there's a read across for the global economy. I mean, he's probably right. Inflation is high and sticky. There's a natural self-reinforcing feedback mechanism because people won't be able to spend, and the second half of the year is going to be much weaker than the first half. So he's being quite open about this, and I've got this vision of a window that's open for the hikes to be done, but it won't be open for very long. And maybe that's what they're saying. We need to get this done because it's not going to be appropriate to be tightening later this year.
Steve, on QT, and this is one of the most interesting things for the markets. What does it mean for front-end gilts?
Front end doesn't mean very much. If anything, it's probably positive. In other words, it could be lower front end yields, because if QT is a form of tightening, and this is active QT, which is not the passive kind we've been used to, then it's more for the longer end. And if it does tighten financial conditions, then presumably it means less rate hikes. Right. Now, I don't have an exact formula, no one does, but imagine it could take the edge off of the rate hike. Net, it should mean lower yields at the front end than would otherwise be the case. Yeah.
One of the questions we're putting to a lot of our key guests over the last few days has been, can the Eurozone avoid a recession? Yeah. And how would you position around that eventuality?
Well, the proximity to the war is part of the challenge here, and also the sensitivity to energy prices, and it does look like the recession risk is very high, and therefore for the ECB, desperate to get away from negative rates, that window is open, but it could slam shut very quickly.
Particularly if they're not looking until July.
Well, this is the challenge, isn't it? Because by July the Fed's at 2%. If they've done 250s. So,
Stephen, are you going to see why? I mean, we saw this gap widen today between Italian BTPs and German bunds. Is that just going to continue as the ECB gets more hawkish?
Well, that's the other angle to the policy that the Fed and the Bank of England don't have. It's the credit side, if you like, sovereign credit and corporate credit. And a big part of the policy has been containing those spreads. Now, they can do it through the reinvestment policy using the PEP or some other devices that they could come up with. So that is an incredibly important part of policy because it's the transmission mechanism in economics terms. And they can't allow Italian spreads to go too far. And I think it's already front page news that the spread is where it is.
Talk to me about R-star, which I want to ask you earlier. Has it moved higher?
This is unobservable. And any economist will tell you that you can maybe observe it with hindsight using a model. But even if you have an estimate, the confidence interval is huge, 100 basis points maybe either side. But there's no evidence that it has gone up. Maybe the risk around it is increasing, but none of the central banks have revised their estimates higher yet. But I would suggest that the drivers of our style, which is the longer run real natural rate, the drivers are about demographics and debt and technology, wealth inequality, globalization. These are things that predated the pandemic and the GFC, and there's a powerful trend in place. So unless someone comes up with a coherent argument that says that the weighted average of these variables is swinging round, I don't really see why we would revise up so thank you. Yeah.
Thank you, Stephen. That was a good answer. Stephen Major there, Global Head of Fixed Income Research at HSBC. Coming up, the sale of Chelsea Football Club. Steve is a fan. He's not. He's going to kill me for saying that. It appears to be moving closer with a deal possibly being finalized today. We have the latest on that next. This is Bloomberg.
Energy prices and a short supply of key chemicals that produce synthetic fertilizers are sending pig, cow and horse manure prices soaring. Even human waste is in demand as farmers hunt for alternatives. Fertilizer helps increase crop yields.
You can see how much moisture is held into this. It's a lot of organic material into the compost, so it breaks down. The manure and the straw breaks down into a friable mix that can be mixed into your soil in the ground and for growing a whole range of different vegetables. Holds the nutrients in, holds the water in, and it really increases the kind of biodynamic profile of the soil.
The recent price spike could mean more farmers going organic for the long term.
Stocked early enough all these precious materials you were just mentioning, and we were on the lucky side that our prognosis was spot on in a way, forecasting what kind of material we would need and what quantity we would need.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed. Welcome back to the Open. Now, Bloomberg has learned through its excellent China team on the mainland that China has ordered government agencies and state-backed corporations to replace foreign computers with domestic alternatives. That's within 2 years. Joining us now is our executive editor for Greater China, John Liu. John, what spurred this move then? What do we know about this decision-making?
Well, Beijing has been trying for years to reduce its reliance on foreign technology. Obviously, you have allegations going back and forth between the U.S. and China about hacking. The Chinese have famously called the U.S. the world champion of hacking. And so this is sort of the next step on that process of trying to make the government especially more secure when it comes to electronic communications. And so they are going to be removing those PCs. We're talking about 50 million PCs at the central government level, more when you include state-owned enterprises. And, of course, they are going to expand this to the provincial level later on, so even more still.
John, what does that mean for, is this a strategic move that will just, accelerate? I don't know what the read across is in 3-4 years down the line, and what does it mean for a lot of these big international tech companies?
I think this is just another sign of this great decoupling that's happening between the U.S. and China, the two biggest economies in the world. I think it's most pronounced when it comes to technology. So we've seen chips, we've seen software, now we're seeing PCs. Obviously, all the stuff that's happened with Huawei over the last couple of years. I think you will just see this become more pronounced and more explicit as the years go on.
John, what does it tell us about the domestic champions then and how good they are at replacing some of these US and foreign companies with hardware and software?
I mean, if the Chinese had had their choice, they would have done this earlier. The problem was there weren't these domestically produced options. That's changing now. So you have companies like Huawei, like Xiaomi, companies that can produce hardware that's just as good, essentially as good as anything you get from HP or Dell. And so that's what's happening now. That's another reason why this step is being taken now.
John, thanks so much. John Luther, our executive editor for Greater China, joining us. Now, Bloomberg has also learned that we're on fire with the scoops today. Bloomberg has also learned that a deal regarding the sale of Chelsea Football Club may be announced today. That would end a 2-month process after Roman Abramovich was sanctioned by the UK government following Russia's invasion of Ukraine. Well, let's get straight to the story with Bloomberg's Laura Wright. Laura, I'm a Chelsea fan, so leave all of this passion to one side. Who's the new likely owner of Chelsea, and what would a deal say about American influence in Premier League?
Well, the new owner, Francine, is likely to be American. Todd Boehly is leading the consortium that are seen as the front runners in a sale of Chelsea. He's formerly a president at Guggenheim Partners, and he founded Elridge. He has experience owning sports teams as the co-owner of the US baseball team, the LA Dodgers. Now, there is a sense of urgency with this deal because the special operating license granted by the UK government will end on May the 31st, and the UK Culture Secretary, Nadine Dorries, has signalled that Chelsea is already surviving on borrowed time. It's been a competitive bidding process. Todd Boehly has outmaneuvered other wealthy US investors, including the Bain Capital co-chairman Steve Pagliuca and also the Apollo Global Management co-founder Josh Harris. There was also a rogue bid last week from Britain's wealthiest person, Jim Ratcliffe, albeit that bid was shut down early on by Rain, the US investment bank who are orchestrating the sale. Now, if this deal is concluded, it would be significant, showing the increasing influence of Americans in the Premier League. Right now, 8 of 20 Premier League teams have some form of American influence, and of those, Arsenal, Liverpool and Man United are wholly owned by Americans. A few reasons for this: the Premier League is seen as the most lucrative football league in the world, high quality players, also a perception that UK football less monetized, less commercialized than in the United States, and finally, football, well, it's a classic trophy asset for billionaires. The US has the most billionaires in the world.
I don't know if we can forgive Francine for being a Chelsea fan, but let's zoom in. Can we zoom in on the Gunners, please? Let's just zoom in. Hold that. Just hold that there.
I was
on the
behind the
Gunners.
consortium. It didn't
Well,
go
I'm
through.
a Crystal Palace fan now since I've moved to South London, so allegiances can change.
Slightly less worse than Chelsea.
Tom McKenzie, how dare you?
I'm just stating facts. This is objective fact statement in a reporting and editorial sense. There's a loan question as well. Just briefly, Laura.
Yeah, quick note on this. It became contentious during his tenure as Chelsea owner. Abramovich lent the club £1.5 billion. He said initially he didn't want it back when the club went on sale. Reports emerged earlier this week stating bidders had been asked to contribute an extra £1.5 billion, but a statement last night from Abramovich's spokesperson refutes those claims.
Great stuff. Laura's been across this story for us. We'll continue to be, and we'll keep monitoring for it. Important, of course, within the football market. Plenty more coming in. This is the end for the European market open this Friday. Surveillance Early Edition is up next. Stay with us. This is Bloomberg.
Companies now, they're getting hundreds, maybe even thousands of applications. So software has come in to automate the process.
You want to write your resume for robots, not for humans. The only job your resume has is to be comprehensible to the software that is reading it, because that software or robot is going to decide whether or not a human ever gets their eyes on it.
These things are programmed by a certain segment of the population that might not be totally inclusive or not be fully aware.
Concerns about how this technology could exacerbate discrimination. For the FTC, I think foremost, the FTC needs to be making sure that we're fully understanding this technology.
We don't trust companies to self-regulate when it comes to pollution. We don't trust them to self-regulate when it comes to workplace comp. Why on earth would we trust them to self-regulate AI?
We think that a lot of the work in terms of the cure is going to be done by the fact that we are experiencing a historically large shock to real incomes in this country coming from outside the country.
So it's not a situation that calls for an emergency type of move, and I think he very clearly took 75 basis points off the table.
We think there are risks on the upside to inflation, but we also think that the core story here is a big real income shock to the country.
This is Bloomberg Surveillance, Early Edition, with Francine Lacqua.
Well, good morning, everyone, and welcome to Bloomberg Surveillance Early Edition on this Friday, the 6th of May. I'm Francine Lacqua here in London, and here's what's coming up on today's program. Bear scare, U.S. stocks crater, wiping out $1.3 trillion. The sell-off continues in Asia and Europe. The hawks fly in Frankfurt, while Austria's Robert Holzmann says the ECB could decide on a rate hike next month, with other governing council members pushing for July. And Chelsea is close to signing a sale agreement with a group led by the former Guggenheim Partners president, Todd Boehly. A deal could be reached today. That's according to Bloomberg reporting. Now, first thing is first, let's check in on the markets. So we did have quite a bloodbath when it came to the stocks yesterday. Some of them, including the Nasdaq, the S&P, down between 3% and 4%. Now, we're still seeing quite a lot of pressure on these European stocks, down 1%. But of course, it's a different story here because of valuation. A lot of the stocks here were cheaper. So when investors panic about inflation, maybe they look to the U.S. first because, of course, there's been a lot of investors buying tech day in, day out because they were a safe asset. The U.S. 10-year yield, we just had a great conversation with our Stephen Major, 3.07. Stephen Major of HSBC saying, look, his calls on treasuries stick, but there could be a policy mistake coming our way. And then when it comes to crude oil, 108, this is a story of the EU also trying, of course, to get away from Russian oil and gas, and the S&P futures down some 0.4%. Again, this is not the kind of major pressure that we saw yesterday. We also look at China, and we've seen in the last couple of days some of these markets really change on flipping out very quickly. So watch out for the next couple of hours as we get into that European Open. This is a picture across the board in Europe. If we get that up, but the main story is actually bonds and the difference between Italian BTBs and German Bunds. This is as we also see the ECB becoming much more hawkish, and then we have a lot of pressure on some of the travel and leisure. The CAC 40 down 1%. Here, the FTSE over in the UK down some 0.6%. So just today, after notching the biggest rally in 2 years, the S&P yesterday tumbled, with 95% of its companies moving lower. Traders really expressing their concern that officials could struggle to fight persistently high inflation amid the lingering threat of a recession.
this is not a good day. This is not a good year.
We are already pretty firmly in a big bear market.
At the end of the day, it's about inflation.
I think that the market is trying to determine what is the most important factor going forward. So for the Fed, it's very clear. They are a single mandate Fed right now. They are only focused on inflation, and they're telling us that.
I believe the market's going to go at least 50% below its peak.
We think things are overdone. You've gotten rid of some of the excesses, and the underlying fundamentals are still relatively good for now.
So to talk about this correction, to talk about the markets, we're joined by Bloomberg's markets editor, Eddie van der Veld, and John Bilton, head of global multi-asset strategy at JP Morgan Asset Management. Now we're looking at a brontosaurus because this is, without a doubt, my morning must-read. Bloomberg opinion columnist John Authers writes in his latest column that the recent volatility seen in the markets reflects a slow-moving realization of the pain of inflation. Now he uses a Jeremy Grantham analogy of the brontosaurus. I feel like I'm an expert on dinosaurs. And brontosaurus basically has a brain and a nervous system that were so inefficient that it would take a long time to realize that it had been bitten in the tail. So we're joined by John and Eddie for the very latest. John, I mean, this actually I feel like is a great analogy because you had the inflation data, you had the Fed data, and suddenly the market's saying, wait, how do I trade inflation? Then we saw this huge sell-off yesterday.
I think it's an interesting analogy, but let's actually look at what markets do.
Yeah.
Markets are a pricing mechanism for the future, not what's just happened. Yeah. And I think what the world is trying to figure out, and one of the reasons we're seeing all this volatility in the stocks all around the globe, is because we're trying to calibrate, where is peak hawkishness, where is peak inflation, how do we deal with an economy which below the surface actually has quite a lot of good data still coming out.
But what happened yesterday? So if you look at the NASDAQ, if you look at the S&P down 5%, this is the inflation data and what we heard from the Fed. What are they looking at that we didn't see last week?
Well, I think, you had a big rally out of the Fed announcement when 75 bips was taken off the table, some sort of relief that we're not going to get this sort of further reach into hawkishness. And then questions coming out when we see data, or we see the announcements from the Bank of England. We see the zero COVID measures being doubled down on in China. Issues that are continuing to worry the market. We are trying to calibrate to a new regime and also at the same time figure out what that regime is.
Eddie, what do you make of what we saw yesterday? And I mean, John is not giving me full marks for my brontosaurus analogy, but the reaction function, I feel it just takes a long time to play out. So how many more volatile days could we see?
Yeah, Francine, I think that's because you picked a brontosaurus. I think what we really wanted to see is either a T-Rex or even Godzilla here, because I think the Fed has really put the spanner in the works here, and I think we could see something really scary coming out of the woods, because I think what markets are asking themselves at the moment is, why not 75? Why is it that the Fed is suddenly saying, well, hang on a second, 50 is enough, but 75 may just be enough to topple this economy over? And I think what they are worried about, I think they're worried about the bits that they can't see. So I think they worried about what we're going to learn and just how scary the growth picture is at the time when inflation is so hot. Because I think just to stretch that analogy, I think stagflation is the T-Rex in this conversation.
Okay, and then I mean, John's one of the guys that calls the markets better. So you're a velociraptor in this. What do you see? Where do you tactically actually look at market corrections?
So markets correct through bull phases. That's been known for some time. The idea that we are seeing a growth slowdown, massive and accelerating inflation, I think the data are beginning to suggest we may be peaking out in that. When it comes to the inflation level, prevailing levels of inflation have caught central banks by surprise. There is no mistake in that.
Why?
Why? Because I think it was seen initially as being a purely supply-side issue linked to COVID and then latterly to the invasion of Ukraine. Today, I think it's being clear that there's a second-order effect where it's creeping through into wages. Things like average hourly earnings today are going to be watched very, very closely. The core CPI print next week is going to be watched very closely. The Fed will not step into dovish territory until they know that they've started to win against inflation. But at the moment, if they're responding to a sequential increase in inflation, which they can't see either, they may risk making a policy mistake in the other direction. Underneath the surface, though, labour is strong, growth is solid, Look at services ISMs. They
Not
came in
bad,
very
yeah.
strong. This is not an economy fighting for growth.
Let's also hear from the Bank of England governor who spoke to our Guy Johnson yesterday about incomes.
We think that a lot of the work in terms of the cure is going to be done by the fact that we are experiencing a historically large shock to real incomes in this country coming from outside the country. So it's a terms of trade shock in that sense. Import prices are rising. That's predominantly energy, food, and some core goods.
Eddie, if you look both at stocks and bonds, they've actually been down pretty significantly this year. Like, who's right? When does this stop? We've never seen anything like this in the last 3 decades.
Yeah, but I think we're going to have to get used to seeing more of this in the next decade, right? Because I think that 60-40 portfolio, a lot of people have been, talking about it becoming extinct like those dinosaurs we've been talking about. But I think, I think this is a real risk because I think stocks have become so dependent on ever lower rates. And, rates are going to have to go up if inflation keeps going where it's going. And even the long end of the curve, we're going to have to see that move higher. And I think that just makes the situation for the stock market broadly precarious. But I do think that right now we are going to see, we're seeing the seeds of the future economy. So what we're going to see here is a lot of active management, a lot of stock picking, and I think that's where people are going to make their money.
Okay, we're going to push John to see how he earns those fees. He's been doing a great job, but, we'll push a little bit further to see what clients want from him. Eddie, thanks so much. Bloomberg's markets editor, Eddie van der Walt, and John Bilton, I'm not picking on you, head of global multi-asset strategy at JP Morgan Asset Management, stays with us. Coming up, China orders central government agencies to replace foreign-branded personal computers with domestic alternatives within 2 years. That story's next, and this is Bloomberg.
city of Jamnagar is a money-making machine for Asia's richest man, Mukesh Ambani. His company Reliance has the world's biggest oil refinery complex here in the city. Jamnagar is also where Ambani is making his newest bet, a $10 billion investment in green energy. His ambition is closely aligned with the Indian government's plan to reach net zero emissions by 2070. But Ambani is not alone. India's second richest man, Gautam Adani, has committed $20 billion of investment over the next decade. But India's massive dependencies on fossil fuels have some environmental advocates questioning the realism and sincerity of those green ambitions and those of its two biggest billionaires.
Lots happening on Wall Street.
It's the basic law of economics.
It validated what the market was already pricing.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
It's a challenging dynamic.
We could continue to see that kind of strength.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, China has ordered central government agencies and state-backed corporations to replace foreign-branded personal computers with domestic alternatives within 2 years. It marks one of Beijing's most aggressive efforts so far to eradicate key overseas technology from within its most sensitive organizations. Well, joining us now is Bloomberg's chief Asia economics correspondent, Enda Curran. So, Enda, this feels very significant. How far will they go?
You're still talking about maybe 50 million PCs being impacted by this, Francine. It does accelerate what China has been trying to do in recent years, which is build more of its own self-reliance on homegrown technology and homegrown hardware. So it certainly speaks to that ongoing push. And on the other side of the ledger, of course, it speaks to concerns over vulnerabilities on the national security front. Remember, some of China's national champions like Huawei have been targeted by the US with sanctions and other measures over recent years that have really crippled them. Well, China's obviously trying to shore up its defenses in that front now. And I think more broadly, it speaks to the idea that China is trying to push for self-reliance. There is that sense of decoupling or fragmentation of the global economy going on. And it certainly doesn't speak to any meeting of minds when it comes to even economic relations between the world's two biggest economies, China and the US.
Thank you so much. Our Bloomberg chief Asia correspondent there, Enda Curran, with, of course, security implications between China and the West. Now, top EU policymakers are also meeting in Salzburg today to discuss the bloc's response to rising inflation. That's as a growing number of ECB Governing Council members push for faster normalization that could see a rate hike in the coming months. Well, joining us now is Bloomberg's European correspondent, Maria Tadeo, who's reporting live from Salzburg, beautiful Salzburg. Maria, you had a wonderful interview earlier on, and I have to say the biggest headache for European politicians and officials, of course, inflation. What does it mean for ECB?
Yes, Francine, and you know, it's very clear now when you talk to officials here, they'll tell you the biggest concern is the inflation picture because a lot of the factors we can't control. Francine, a lot of this is about the energy situation. We know that the second round effects of those sanctions that the European Union is pushing through will have an impact on petrol prices, fuel prices. All of this goes straight to consumers, but also then you have the food angle to this. Ukraine is a huge agricultural hub, and of course they can't harvest in these conditions. So for European officials, it really is about the inflation picture, showing that they have the credentials, the credibility to really signal that they're well anchored and the European Central Bank can get a hold of it. The reality is, Francine, having said that, is that the numbers do show runaway inflation. There is now open talk here. Perhaps they don't want to say it publicly about this imminent recession, this stagflation also happening, and possibly this push, this big drive to get a rate hike that could happen maybe June, July. We know the market and Christine Lagarde has guided investors very clearly. First you end QE and then we move into the hike. But I think at this point, Francine, the sense of direction is very clear. There will be a hike in the summer. It's just a question of when, although the market believes probably in July. We have seen from a number of officials, including Mr. Holtzmann, the central banker of Austria, where I'm in, saying why not do it in June?
Yeah, I mean, and it does, you know, that's widening, of course, spreads between Italian BDPs and German bonds. Thank you so much. Our European correspondent, Maria Tadeo, reporting from Salzburg. Let's go back to John Bilton, head of global multi-asset strategy at JP Morgan Asset Management. John, you have China, and there's definitely, I guess, more concern about their interaction with the West, trying to get some of the supply chains back home. And at the same time, you have Europe dealing with this inflation. Where do you find value, given everything that's going on in the markets? You know, where do you find value for stocks?
Well, I think first and foremost, you've got to look at your overall positioning. You know, you've got to trust the data more than the headlines. It's really that simple. The data are still telling us a story that there is underlying resilience in the economy, but markets are repricing to an uncertain future today. Right. And to do that, they are reducing the levels of valuation you're prepared to pay for future cash flow. So what do you look for? You look for solid cash flow. You know, parts of the real asset market, parts of the real estate market provide that. You look at strong cash flow return in stocks. You look for those the big dividend players. At the moment, energy really has had a very strong upsurge. But remember, this may not be a permanent state of the world. As we see ESG pressures continuing, you know, we're enjoying the benefits from higher energy prices coming through today, but that may not last. So we have to be a little bit more selective and tactical.
Is it binary, the outcome, that either we get through this and we have a soft landing, or actually we could see a pretty heavy recession if the war is long-lasting?
I think at the moment the setup isn't there for a recession imminently. Could we get to a point where central banks have to cool the economy, have to cool demand in order to address inflation? That is certainly a risk, but I don't think it's a 2022 risk. It's more getting into, certainly into next year at the earliest. Underlying the economy, we've still got 13, 14% additional excess savings above the 2019 level that we have across the EU. Yeah. As a result, there's a lot of resilience. Higher prices can be managed to a degree.
But what do you make the difference? I mean, if you look at the differential, so you have PBOC against the Fed in terms of what the kind of support they're giving to the economy, but you also have a very different valuation, picture in Europe for the US. How do you play those two?
Well, I think in Europe has always tended to trade at a discount to the US, and the discount is relatively wide. But the US, is down, depending on where you see forward earnings on the S&P 500, 230, 240 over the next 12 months, you're on 17 or 18 times earnings. That is not as aggressively valued as it was. It's not as cheap as Europe, but Europe, of course, has the geopolitical angle as well. I would go back to the underlying shape of the economy. We do not expect a recession in 2022. The risks have risen for 2023, but the resilience of balance sheets, the low levels of leverage across the banking sector, all point to the ability to be able to see this recovery continue.
I know you're a huge Chelsea fan. I'm kidding. You're not a Chelsea fan, but
no.
Do you feel? I know you're not, but I am. I just want a buddy to be a Chelsea fan with me. I mean, we're seeing so much money, especially like private equity trying to get into a Premier League. Is this a good deal?
In all honesty, I have no idea. I'm
so you didn't put a consortium together?
I'm afraid you're asking the wrong person on football finance.
What? Is there a lot of cheap money actually out there just waiting to be spent on the sidelines, football or not? I mean, I'm making a joke about football, but it's there.
So certainly one of the issues for private equity, as we know going into this period of volatility, we've not heard so much of it lately, was that large amount of cash, that large amount of dry powder on the sidelines. But the thing is, bear in mind, there's also a lot of investable opportunity out there. We're seeing automation continue, improved technology, improved communications, next generation robotics. There's a lot to invest in. Valuations have come down. If anything, opportunities for private equity, they take the long view. They're not looking at the next couple of Fed meetings. They're looking 10 years out. And so that cash on their investable cash actually could be good for growth over the longer run.
Are you a cricket fan?
Oh, yes.
Well, there you go. Cricket and rugby. I knew you'd be. John Bilton, thank you so much for joining us. Head of Global Multi-Asset Strategy at JP Morgan Asset Management. Now, coming up later in the program, we'll also speak to Patrick Armstrong. He's Plurimi Wealth Management, Partner and Chief Investment Officer. We'll discuss sell-off the Fed. Maybe we'll talk a bit of football, but of course we'll talk about the upcoming U.S. jobs data as well. This is Bloomberg.
Delhi airport, and behind me you can see SpiceJet 737 MAX aircraft. That Boeing is going to compensate SpiceJet in form of cash and aircraft. There's a big celebration happening at the Gwalior airport. As you can see, they've literally rolled down the red carpet for SpiceJet chairman Ajay Singh. There are balloons, there are flowers. This is a big deal for SpiceJet because it is the only Indian operator of Boeing 737 MAX planes currently.
However you get your news.
This is Bloomberg Daybreak with Lee.
On Bloomberg Radio.
Welcome to Daybreak Australia. This is Bloomberg Technology. This is Bloomberg Green.
On TV, radio, and the web, this is Bloomberg.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now let's get straight to the Bloomberg Business Flash. Here's Leanne Gerrans. Hi, Leanne.
Hi, Francine. Bloomberg has learned the European Union is proposing a revision to its Russian oil ban to give Hungary and Slovakia an extra year to comply. Under the plan, the two countries will have until the end of 2024 to stop imports. Most member states will be expected to phase out Russian fuel by the end of this year. Now, ING has reported first quarter profit that missed analyst estimates after the bank set aside more than expected to cover the cost of loans going sour because of Russia's invasion of Ukraine. The biggest Dutch lender put aside 834 million euros related to its Russia exposure. The US Federal Trade Commission is said to be reviewing Elon Musk's $44 billion Twitter takeover, setting up a deadline in the next month for the agency to decide whether to conduct an in-depth review of that transaction. Under US merger law, Musk is required to notify the FTC of the transaction and wait at least 30 days before closing to allow an investigation into potential antitrust concerns. Chelsea Football Club is close to signing a sale agreement with a group led by former Guggenheim Partners president Todd Boehly. Sources say Boehly's consortium could reach agreement as soon as today with Chelsea and its owner, the sanctioned Russian oligarch Roman Abramovich. A deal would end a weeks-long bidding process for one of the biggest English football clubs. And Peloton is said to be exploring a sale of a sizable minority stake to shore up business as the company's stock continues to sink. The hope is to find a big-name corporation or private equity firm that can help validate the business with its investment. Peloton's value has plummeted from those pandemic highs. And that's your Bloomberg Business Flash. Francine.
Leanne, I know you won't break my heart, so I know you won't say you hate Chelsea, but a lot of people are at the moment. And Lucy and I, we're hanging strong Chelsea supporters. Coming up, we talk to Plurimi Wealth Management Partner and Chief Investment Officer Patrick Armstrong. This is Bloomberg.
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
But ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. The place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
Front Row, exclusive interviews with the most influential figures in finance. Lloyd Blankfein.
Deflation is a terrible thing. Inflation you could tolerate.
Kathy Wood.
Tesla will be in the pole position to dominate.
Jeremy Grantham.
We've had a very, very abnormal honeymoon Goldilocks period.
First available on the Bloomberg Terminal, then on Bloomberg Television and Bloomberg.com. Front Row, the best seats in the house for business's greatest minds. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question. It's a great question.
Great question.
Great question. Great question. Great question.
That's going to be the best question I get all night. I'm glad you asked that.
Bloomberg Television. Top experts. Great questions.
This is a market that, over the past few weeks, has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Bear scare, U.S. stocks crater, wiping out $1.3 trillion. The sell-off continues in Asia and Europe. The hawks fly in Frankfurt. The ECB's François Villeroy de Galhau says interest rates may be raised back above zero this year. And Chelsea is close to signing a sale agreement with a group led by the former Guggenheim Partners president Todd Boehly. A deal could be reached today. That's according to Bloomberg reporting. Now, good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. We'll get on to Chelsea. We're fans here on Bloomberg Surveillance Early Edition. Not everyone, but a lot of us are. But first to the markets, because it was a wild ride when you look at what happened overnight in the U.S. This is either, we'll speak to Patrick Armstrong about it. This is either short positionings, people getting out, or it's really misunderstanding how you trade inflation and the longer term implications of what's happening. My producer is just writing in for a correction. I think we're more Arsenal fans than Chelsea. Stocks sliding, bonds sliding, the dollar rising as inflation and rising borrowing costs. China's COVID lockdowns also overall depressing sentiment. Now, U.S. markets plunged yesterday, wiping $1.3 billion in value. It just continues what has been a remarkable year in markets, with both stocks and bonds posting significant losses. We're now joined by Patrick Armstrong, Chief Investment Officer at Plurimi Wealth. Patrick, I know you like the Brontosaurus analogy, which is there's a nervous system that maybe takes a bit of time to connect between, how you look at inflation, how you trade it. But what happened yesterday in U.S. markets?
Yeah, John Arthurs is great with his metaphors about the Brontosaurus. And it's, I think Jerome Powell is got to decide between which policy mistake he's going to make. And I think the markets really rejoiced that it looked like he was going to take the dovish route, which meant I don't want to provoke a recession. And then it sunk in that, okay, if he's not going to do that, he's going to keep stoking inflation, and that comes with its own consequences. And you don't want to be long duration if inflation is being stoked. So
Patrick,
bonds sell off, high multiple stocks sell off.
You're so depressing. I mean, when you look at what policy mistake, which one's better in terms of policy mistake to do? I
think right now, he's making the right decision, letting inflation stay hot and run the risk of that rather than provoking the imminent recession. He said there's a potential for a softish landing, and he's kidding himself, trying to kid us. You've got to give people hope in his job, but it can't be done. After the trillions of experimental policies that have been put in place, you've got too much volatility and swing of things. You've got inflation running near double digits, and you've got a slowing economy already, so you've got to be hiking into a slowing economy.
There's the Brontosaurus. Patrick Armstrong, I have to tell everyone, is one of the foremost experts on dinosaurs. I mean, this is what having young kids does to you. Patrick, is there a danger of a market reaction or a market function, or is it that, as you say, because of these possible two policy mistakes, it's almost binary, the outcome?
You've got to look what the Fed does, but just look, if you pull up a chart going back to when I was born in 1970, every Fed hiking cycle, there's almost always been a recession following it. So the Fed almost has always hiked too far. And the only time they've not provoked a recession is when there's been some sort of exogenous positive shock that basically happened at the same time as the hiking. So in the mid-90s, they were hiking. The recession didn't follow because of the massive productivity increase from the internet. In the early 80s, you had Saudi Arabia and OPEC really pumping crude into the market, giving the U.S. consumer a real tax cut.
But
where's that going to come from this time in this hiking cycle, that exogenous shock on the positive side of things?
But it's also 10 years of ultra-loose monetary policy and QE.
Yeah, and that's led to malinvestment in non-productive assets. It's led to people buying dream stocks, hoping to get rich quick. And it's taken basically all the moral hazard of it. It's basically taken risk away from people. And now we're getting back into an environment where you do have to think there's consequences to what I buy. Whereas a few years ago, you had to buy something and just wait for it to go up.
Are you expecting more of a correction? And actually, if you look at the models for fee earnings, then it could potentially change everything for asset managers.
Yeah, asset managers are seeing, I think the chart you just started this segment with equities and bonds both being down 10% year to date. And stagflation is toxic for traditional assets. It's bad. The stag is bad for the equities. The inflation is bad for bonds. And you've got to be a little bit more creative. You want to be short duration. You want to be long companies that are producing cash flow today, not that have a hope of producing cash flow in 10 years' time. You want to be long, higher quality credit with shorter duration, and you get returns equal to inflation on that now. A few years ago, if you did that, you were losing purchasing power. But with spreads widening and interest rates going up, you can preserve your capital relatively safely for the first time as well.
Who's right, bonds or stocks? Or should we not look at it like that?
Well, they're both right year to date. They're both down 10%, and that's just an acknowledgement that we're in a stagflationary environment. I think bond yields are going to continue to move higher because I think Powell's going to blink and say, I accept inflation rather than provoking recession. But that's an uncertainty. It's a guess on which way Powell's going to go. He's shown with his pivot in 2018 that that's how he thinks about things, but it's still uncertain.
I mean, we saw that with him taking off 75 basis points off the table. Was that a mistake?
I don't know if it was a mistake. He wanted to calm the markets and said we're going to go about things deliberately. He's showing he's not asleep at the wheel, that he said there's going to be 50 and 50 for the next two as well. An extra 25 basis points is symbolic more than having a real economic impact, I think. So everything he does can be viewed as a mistake because there's going to be no right answers, unfortunately. He's got to find the answer that's less wrong. And I expect that'll be still provoking inflation and trying to avoid the recession.
Patrick, thanks so much. Patrick Armstrong, their Chief Investment Officer at Plurimi Wealth, stays with us. Also coming up, the sale of Chelsea Football Club appears to be moving closer, with the deal possibly being finalized today. Patrick Armstrong, not a Chelsea fan, so I forbid him to talk about this. We have the latest on that next. This is Bloomberg.
during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. To the markets, because there's quite a lot going on. It started yesterday overnight in the US, where we saw huge losses across the board. If we have an asset board, we'll bring it up, because we saw the S&P 500, the NASDAQ, and others really being slammed. Now, Bloomberg has also learned that a deal regarding the sale of Chelsea Football Club may be announced today. That would end a 2-month process after Roman Abramovich was sanctioned by the UK government following Russia's invasion of Ukraine. Let's get the story with our Laura Wright. Laura, who's the new owner likely to be, and what would a deal actually say about this American influence in the Premier League?
Well, some exciting news, Francine, for your local club, Chelsea. The new owner expected to be American Todd Boehly, former president at Guggenheim Partners and the founder of Elridge. Look, he has experience owning sports teams. He's the co-owner of the LA Dodgers, a US baseball team. There is a sense of urgency surrounding this deal, considering the special operating license that the UK government granted Chelsea will run out on May the 31st. The government have signaled little appetite to extend it, with the Culture Secretary Nadine Dorries admitting Chelsea is already functioning on borrowed time. This has been a competitive 2-month bidding process, and if successful, Todd Boehly's consortium have fought off some stiff competition from other wealthy US private equity investors, including the Bain Capital co-chairman Steve Pagliuca and the Apollo Global Management co-founder, whose name escapes me at this present time, Francine. But look, this is important because the influence of Americans in the Premier League, already 8 out of 20 Premier League football clubs have some form of American influence. 3 of those, Liverpool, Arsenal, Man United, are wholly owned. And the Premier League, look, it's seen as attractive for a number of reasons. It's considered as the most lucrative football league in the world. It's seen as less monetized, less commercialized than US Sports League. And yes, football, it's a classic trophy asset.
It is a trophy asset. How much? I mean, I keep on hearing, I was asking everyone I knew, saying, are you putting a consortium together? Are you trying to buy Chelsea? And they're like, $3 billion, no way, it's too expensive. What kind of money's around this deal?
Yeah, well, it could be actually up to £4 billion, Francine. We should see details later today if that deal is in fact signed. But there was, of course, that contentious £1.5 billion loan from Roman Abramovich that was thought to perhaps derail the deal. But it emerged that, after all, Abramovich, he doesn't want that loan repaid. A statement was released by his spokesperson overnight. But this is in the context of an owner that has won 5 Premier League titles, 5 FA Cup titles, 2 Champions League titles with Chelsea. And he just wants to see that the new owners will continue to invest in the academy, in the women's team, and also that all-important stadium redevelopment. Francine, when it happens, I know you're going to be first there with the season ticket.
I mean, of course. I can actually hear them because we live so close. It's very distracting where you're trying to be on TV from your living room. Laura, thank you so much. Bloomberg's Laura Wright. We're back with Patrick Armstrong, Chief Investment Officer at Plurimi Wealth. Patrick, you should have offered that extra $1 billion to get it. You stopped at $2 billion. What is this? I mean, is it a trophy, or are they actually going to try and make money out of it?
They're going to try to make money out of it, and they will make money out of it. Anytime you're buying an asset from a forced seller, you're usually going to get a good price. So there is enough competition that it's not going to be an egregious price, but it's going to be an attractive price. And in a normal...
Terrible for the fans.
Terrible for the fans. You don't want an owner that's trying to make money if you're a fan of the club. There's other things they can do that can immediately monetize it. I think I've read a survey once that if any London club just changed their name from Chelsea to London Chelsea, they'd get $1 billion from that, from China and America, who don't know where Chelsea is, and they love London, things like that. So there may be some things that are really off-putting for Chelsea fans, that they're trying to make a pound or a dollar.
London, Chelsea, you're breaking my heart. I feel like me and Lucy, the floor manager, were like the only fans left out there of Chelsea.
But yeah, those are the kind of levers when you get private equity investors trying to maximize the value of their asset. They're not doing things just for the fan.
I mean, can you make money? I know you can make real money in sports, which is why we had that Super League that then kind of went down in flames. Yeah. Is there anything for you as an investor that you want to look at?
They're fully priced. If you want to have a controlling stake in these things, you don't want to be a minority owner in them. And then you can force the egregious things that the fans don't want. So I've not been attracted to any of the publicly listed vehicles, and those would be my routes to buy these kind of things.
Yeah, a message directly to Mr. Bowley. Think of the fans. That's the only thing you need to do today. Think of the fans. Patrick, when you look at China and actually what they're trying to do with, cutting down, first of all, for the people that are in government in using some of this technology that's foreign, are we going to see a world where there's going to be such a huge split between China, Russia, maybe even India and the rest of the world, that it will change everything economically and it'll change a lot for these big companies?
It's looking like it might be going down that path. There's still off routes that we may not go down that path, but we are in a bifurcated world, potentially, where you've got authoritarian states on one side, a Western democracy on the other side, and some middle ground countries that are trying to play into both of those two types of regimes. It is a world of deglobalization, unequivocally. So we've gone from the 80s, where Volcker broke inflation's back, and we moved into deregulation and globalization, lower costs. The pendulum swung the other way now. Protectionism, stagflation, and populism.
And what do you do with all of these tech stocks? I know it's, this is a step away, but these are the companies that did so well in the pandemic because we thought everyone would order their food in, we'd all be on Zoom and just talk through our technology and phones.
Those kind of tech stocks, avoid. They still got a lot further to fall, I think. These are companies that are producing products and selling their product below the costs. That's why they're making losses, and the hope when the interest rates were zero that they'd carve out monopoly positions and be able to create profits in the future. The minute Delivery Hero raises prices, Just Eat takes all the market share. The minute Uber raises prices, Lyft takes all the market share. So they have flawed business models. They're still trading at billions in market cap, and they're never going to get on that path to profitability.
Patrick, thank you so much. Patrick Armstrong, their Chief Investment Officer at Plurimi Wealth. I'm still disappointed you didn't buy Chelsea. Think about it. You still have time, like a couple of hours, to put in that second bid. Coming up, Elon Musk secures an extra $7.1 billion of new financing for his Twitter takeover bid, including from Larry Ellison of Binance. We have more on that next. This is Bloomberg.
When you think of cutting-edge technology at sea, you might be thinking of stuff like this. But there's an incoming revolution on the high seas that isn't quite as sexy, but could be significantly more impactful.
Container shipping is the key component of global trade. About 80 or 90% of all the world's goods are transported at sea at some point.
But there's a significant unseen cost to the modern era of global commerce.
About 3% of all the world's CO2 emissions come from shipping.
3% may not sound like a lot, but that's roughly comparable to the entire CO2 output of Germany. Since reducing trade isn't a likely option, what about a technological improvement to help reduce the emissions from these well-stocked maritime behemoths?
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
Economics, finance, politics. This is Bloomberg Surveillance, early edition of Francine Lacqua here in London. Now let's get straight to the Bloomberg First Word News. Here is Leanne Gerrans. Hi, Leanne.
Hi, Francine, and happy Friday. Bloomberg has learned the European Union is proposing a revision to its Russian oil ban to give Hungary and Slovakia an extra year to comply. Under the plan, the two countries will have until the end of 2024 to stop imports. Most member states will be expected to phase out Russian fuel by the end of this year. Now, Bloomberg has learned that China has ordered government agencies and state-backed corporations to replace foreign computers with domestic alternatives within 2 years. Staff are said to have been asked to change their PCs for locally made alternatives that run domestically developed software. The move is one of Beijing's most aggressive efforts so far to eradicate overseas technology. The coronavirus death toll probably climbed to almost 15 million in the first 2 years. That is according to a new report from the World Health Organization, which says about 1 in 500 people died globally during the pandemic. The figure is far higher than the official numbers and includes deaths indirectly caused by disruptions from the crisis. OPEC and its allies are sticking with their standard small monthly production increase in the face of tightening global markets. International consumers have been calling on Saudi Arabia and its partners to fill the gap left by a potential EU ban on Russian oil. The group's latest meeting rubber-stamped another $432,000 barrels a day increase for June. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg. Francine.
Leanne, thanks so much. Now, the Bank of England issued the gloomiest outlook of any major central bank this year as it raised its key rate. Governor Andrew Bailey is warning Britain to brace for double-digit inflation and a prolonged period of stagnation or even a recession.
I think it's interesting with market reaction because we've discussed this. We discussed how we think markets might react, and you can make a case both ways. Actually, we collect a lot of intelligence and information from markets. And our market intelligence team collects a lot of information on what people in markets think we're going to do. It's like looking at yourself in a mirror. And there were arguments both ways. So, some people were saying, well, we're looking at what the vote will be, for instance. I sort of sense from where the markets reacted today, they probably didn't spend that much time on that. And I'm not saying they should, by the way, because I think, I always say, please read the report, read the statement, read the minutes, take the whole thing in.
So what do you say to the market? It's currently got 118, last time I checked, basis points priced in between now and year end. That's just shy of 25 bips per meeting. Is that a misprice? What do you say to the market when it has that kind of expectation built in right now?
Well, I'm not making predictions on what we will do. I think what I would say is this. So we do a market survey. And we publish it. We'll publish the next one tomorrow, but we published one for the last meeting. And what we could observe was that there was a gap between the market prices and what the market was telling us in the survey. So the survey curve, we published this on our website, the survey curve was considerably lower than the market price. Now, you can construct all sorts of arguments about, market prices have a sort of distribution of risks in them, distribution of views of risks in them. The survey is perhaps more of a central case view. But we could observe that the gap between these two things was larger than, it often is. So, we sort of spent a bit of time sort of pondering that.
Bank of England Governor Andrew Bailey there painting a gloomy outlook for the UK economy, speaking to our Guy Johnson. Now, to the latest twists and turns of Elon Musk's efforts to buy Twitter, the Tesla chief executive has secured $7.1 billion of new financing commitments, including from billionaire Larry Ellison, Binance, Sequoia Capital, and that's to help fund his proposed $44 billion takeover. Now, for more, we're joined by Bloomberg's Alex Webb. Alex, I mean, these are some, first of all, good morning, but they're really big backers. Is it that people are attracted to Twitter, that they don't want to say no to Elon Musk? Like, what are some of the dynamics there?
Well, Elon Musk is in the Bay Area, a huge amount of people. You know, there's some more skepticism outside the Bay Area as far as Elon Musk is concerned than there is inside the Bay Area. And they have faith in his ability, it would seem, to actually transform this thing into more of a success than it is now.
What, to make money?
Well, that's the slightly confusing thing, that publicly he's said, I'm not in this to make money. But equally, he's got investors, so he must be telling them, and it's been reported that when he presented to banks, he presented some sort of financial vision to them so that they clearly got on board with it. We don't know what that is. I guess maybe often in Silicon Valley, the perception is, or the model is, make a product people like, and then the economics will follow. So perhaps that is, in a sense, the pitch.
How's the FTC looking at this?
Well, it's looking at two pieces. It's firstly carrying out a review of the deal itself. It seems unlikely that they'll raise any objections. The other thing they're looking at, which could be a little bit more problematic, is how he filed it to begin with. He didn't declare the initial 9% and whatever it was stake in Twitter when he acquired it, because he said, well, this is a financial investment. It's not. I'm not going to do a takeover. Of course, what happened? He then ended up, making an acquisition or a takeover bid for Twitter. So that is the thing they're looking at. Maybe a little more questions and marks around that.
Alex, yesterday we were joking around with the Binance founder that, they should come on the show and do something about crypto on Twitter. And he said, I don't really know Elon Musk. And then we find out subsequently that they're investing in it. I mean, is there a link between crypto, Twitter? Like, what does this end up being?
It is something that the, crypto enthusiast world exactly is getting very ginned up about. That, the whole vision for Web3, this mildly non-specific but decentralized internet where you don't have big tech companies controlling anything. They think this is a great vehicle to push that vision. Now, of course, at the same time, Elon Musk is saying that I want to get rid of all the bots, and a lot of the bots are crypto bots. So, there is a balance there to be found.
Alex, thank you so much. Smart as always, our Bloomberg Quick Take correspondent on technology, Alex Webb. Now, in the meantime, we'll leave you with our morning must-read from John Authors. I love it because, of course, it's talking about dinosaurs, and we're also reaching out to a new audience. I got a note from someone saying the Brontosaurus analogy is just so clever and smart. My 7.5-year-old was watching, and he got so excited. So good morning to all of the 7-year-olds out there. The idea behind John Author's piece is that a Brontosaurus has a nervous system that was so inefficient that it would take a long time to realize it had been bitten in the tail. The analogy could work well with what's going on in the markets today. If you look at markets overall, yesterday they really fell out of bed with the NASDAQ, the S&P between 3 and 5% lower. Stocks and bonds today continuing to fall on inflation worries. Of course, they also worry about rising borrowing costs and China's COVID lockdown, a depressing sentiment. But this is something that we also knew 48 hours ago. So maybe there is a reaction function that takes a bit of time to fall into place. Risk aversion sweeping away the relief rally that we saw just yesterday morning following the Fed decision on Wednesday. Bloomberg Surveillance Early Edition continues in the next hour. Kriti Gupta in New York, Anna Edwards, and Tom McKenzie here in London. This is Bloomberg.
nuestro estudio, en nuestro experimento, no hemos pintado todos los edificios de blanco, sino estos más asequibles de pintar. Y ya hemos detectado reducciones medias en el área metropolitana de 0,8 grados aproximadamente en un periodo de ola de calor y con picos máximos de 4 grados de disminución en un momento puntual del día, en una zona puntual del día. Y como dices, en una ciudad como Barcelona funciona incluso mejor que las zonas verdes, según las modificaciones nos detectan incrementos, o sea, disminuciones de temperaturas mayores con tejados blancos que con incrementos de zonas verdes como tienen planteados el plan director urbanístico.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
I think we're going to stay on the edge of our seats.
I think that the market is trying to determine what is the most important factor going forward. So for the Fed, it's very clear. They are a single mandate Fed right now. They are only focused on inflation, and they're telling us that.
These are three central banks, all with slightly different challenges.
Markets got drunk on liquidity post-COVID.
We think things are overdone. You've gotten rid of some of the excesses, and the underlying fundamentals are still relatively good for now.
This is Bloomberg Surveillance, Early Edition, with Anna Edwards, Matt Miller, and Kaylee Lines.
It's 10 a.m. in London, 5 a.m. in New York, and 5 p.m. in Hong Kong on this Friday, May 6th. Our top stories today. Global stocks and bonds falling after that major sell-off on Wall Street. Investors are worried about inflation, higher interest rates, and the risk of recession. Meanwhile, the US dollar rose against major currencies. The US jobs report's out later today. There's concern that the falling jobless rate and rising wages may lead the Fed to be more aggressive with rate hikes. The report is likely to show the unemployment rate dropping to 3.5%. And China's moving to eradicate key overseas technology. Beijing orders central government agencies and state-backed operations to get rid of foreign personal computers. Welcome to Bloomberg Surveillance Early Edition. I'm Anna Edwards with Tom McKenzie here in London and Kriti Gupta over in New York. Kaylee Lines and Matt Miller are both off today. And Tom, really interesting to see the way that the run-up in stocks and then the subsequent sell-off in stocks on Wall Street is really working its way into the global narrative this morning.
Yeah, and of course that's been felt in Asia. The benchmark, the MSCI Asia Pacific, ended lower. The one area of green was Japan and the Nikkei on the back of reporting there that maybe Japan is going to start welcoming tourists again as the pandemic there eases. That's boosted some of the travel talks linked to Japan and within Japan. But apart from that, the story is one of negativity. As you can see, losses of 1.6%. Concerns again as China reiterates that it's not walking away from its COVID-0 policy. Instead, actually instructing individuals within China not to question that policy. And then, as the headline said, that marked decoupling when it comes to US tech within government agencies and SOEs. The CSI 300, the benchmark, ending lower by 2.5%. The Hang Seng as well, that tech stock rout that we saw in the US with the NASDAQ ending almost 5% lower. That read across to what happened in China because of the ADRs were battered. And you saw that tech stocks listed in Hong Kong, Chinese tech stocks, took a hit of almost 4% as well. well. The Nikkei, as you can see, ended up 0.7%, again, on the back of that reporting around tourism. Let's switch it on and see how things are playing out across the currency space. Then that weakness for the Chinese yuan. Year to date, down about 5% versus the US dollar. It briefly went to 670. That could be another line in the sand for the Chinese currency. Currently at 668, lower by 0.4%. The Japanese yen, lower by about 13% year to date, is 150, the next level for that currency. For Japan, the rate differential, of course, becoming more extreme between the BOJ and the Fed. Of course, when it comes to China, part of it is the dollar mix, part of it is concerns about the trajectory of that economy. And Kriti, for the US, what are you looking at?
Yeah, Tom, we are looking at a little bit of a risk-off mood when it comes to the U.S. Remember, this follows that pretty strong conviction selling that we saw yesterday. But what's interesting to me is yesterday's move, a lot of people are saying, well, it's not necessarily this panic selling that you tend to see. It's really institutionals just not really hopping in, not really buying the dip. A buyer strike, as one of our guests put it yesterday. This is important because it's that sentiment that seems to be carrying on today. Futures down about 0.4%. Even yields, a little bit of a softer move. But remember, yields moved up 16 basis points yesterday when it comes to the 10-year yield, now up about, I believe, 3 or 4 basis points, call it 4 if you will. So you are once again seeing that sell-off pattern in stocks and bonds really continue. And remember, when we talk about that sell-off in yields, we also have to talk about the dollar as well. A little bit stronger this morning, but still a very marginal move. And crude, of course, up 1.5%. This is important as the EU starts to move closer and closer towards that Russian oil ban. What comes next? Does this pave the way for natural gas? Eventually, that's going to be the question we ask there. And even a risk-off tone, you can see it in Bitcoin as well, down about 0.6%, Anna.
Kriti, let's have a look at the European map then, and European equity markets feeling some pain today, it would appear, and perhaps more than we'd anticipated. When looking at the futures picture earlier on, it looked as if a lot of this would be yesterday's story. We worked in some of Wall Street's enthusiasm from Wednesday into the start of our trading day yesterday, and then some of the subsequent sell-off. There was clearly still some to go. And the fact that US futures have been a little bit weaker through the European session also weighing on markets. Add in there some negativity around earnings, and you get a pretty negative picture, down by more than 1% on the CAC 40 and on the Xetra DAX. There's the earnings story, I'll come to that in a moment. There's also the FX story to focus in on, and we continue to see that the pound is weakening against the US dollar. This was happening in the run-up yesterday to the Bank of England meeting yesterday, and continues to be the case afterwards, and is again the case this morning. 123.34 is where we trade on cable, down another 0.2% as we readjust our Bank of England view around, yes, inflation, but also growth. So that's where the market is on that one. The euro, interesting to see how this one dropped in the last 24 hours and then has worked its way back up again, back up to that 105 handle. Yesterday, the focus was on some fairly dovish commentary from one ECB official. Today, the focus on the French side, a slightly more hawkish take on things. And so as a result, we saw a little recovery in the common currency. The Adidas share price down by more than 5%, or Adidas, if you're in some parts of the world, down by more than 5%. This on concerns around their business in China. That is also weighing on some of the Asian providers to Adidas through the Asia session. IAG down by 8.5%. This is the aviation business, the operator of British Airways and Iberia, amongst other airline brands, and they're blaming Omicron basically for the way that their backward-looking numbers disappointed the markets against estimates. Quick look at some Russian assets, and Kriti, we will focus next week on what's going on the inflation side of things. You were talking about the European position on Russian energy, and that is still being closely watched by those who are playing in what some describe as fairly broken markets over in Russia, but that is being watched. And will there be extra time given to Hungary and some other European countries to comply with those rules around oil and energy products from Russia? That is one of the questions hanging over these markets at this point, Kriti.
Yeah, it's a lot of fascinating stuff when it comes to Russia in particular. We have to see how those capital controls really play into the markets and how we are really going to be dealing with that in light of that sanctions ban. Anna, thank you. Let's look at what's coming up ahead today. We're going to hear from the Fed with John Williams, Neil Kashkari, Raphael Bostic, and James Bullard all speaking today, of course, after that quiet period. We'll see what they have to say really on those Federal Reserves. Counting is also underway in the UK local elections. Boris Johnson's Conservatives have already lost control of 3 London strongholds, and we'll get that U.S. jobs report at 8:30 a.m. New York time. Tom, a very heavily watched report as we talk about whether or not how tight this labor market is and just how much work we still have to do.
Yeah, the participation rate and wage increases will be in focus, we know, with the forecast for 380,000 in terms of those non-farm payrolls. And, of course, getting back to that market reaction, the whipsaw that we've seen over the last 24 hours, stocks and bonds, of course, continuing their slide this morning after yesterday's sell-off. Steve Major of HSBC spoke to us earlier.
There's a different mindset that's needed to trade a market like this, because we are clearly in
in a very inflationary time period, and the hawkish response is only just coming through. So the behavior of markets and therefore investors is different to what most people who are trading today would have experienced.
Okay, joining us now is the one and only Eddie van der Volk, Bloomberg Markets live editor. Eddie, talk to us about the market psychology, what it tells us, the delayed response from the equity and bond markets to this decision by Jay Powell from the FOMC and, of course, that presser.
Yeah, you know what? I think Stephen Major made a really interesting point there, that this is a very different environment and the market will have to be ready, you know, thinking on its feet. You can't just buy the indexes. I've been saying that all morning. I think, you know, people need to pass the message a lot more. And I think what came through initially, there was a little bit of relief that the Fed isn't going to hike 75 basis points. You know, they're not going to completely squeeze the market so far. And then people sat back and they said, well, actually, why isn't the Fed even considering 75? Look at where inflation is. What is it that they worried about? Are they seeing something in the growth picture that we're not seeing? Are they worried more about stagflation now? You know, is it no longer just a single focus on you know, can they no longer just singly focus on inflation? They have to start thinking about the growth picture as well. And I think all of that's coming through, and I think all of that will be illuminated by the jobs report later today.
Yeah, absolutely. Moving on to the jobs report, expectations there then, Eddie. Is it a situation where we're going to see even good news interpreted as bad news by the market?
Yeah, over the last few months, the CPI reading has been a much more important reading than the jobs report. You know, we've just seen the volatility around CPI much bigger, but I think that's going to shift back. I think right now that the jobs report will tell us, you know, whether that labor market is still as tight. Is the Fed and wage growth, is wage growth still happening at the pace that it has been? You know, we want to see a little bit more about the participation rate. All of those things will tell us whether the Fed's policy is having any effect and whether it's having too much of an effect. And I think, therefore, you know, the jobs report is becoming the absolute key number for me, again, in markets at the moment.
Yeah, Eddie van der Walt of Bloomberg MLive, I think he's 100% right when he talks about that wage growth. You're really seeing that. So it adds so much pressure to the U.S. jobs report today, which, speaking of, it's expected to show employers added another 380,000 jobs in April, a moderate step down from March. The unemployment rate likely fell to 3.5%, while average hourly earnings rose at a monthly pace of 0.4% and 5.5% on a year-over-year basis. Let's get now to Emily Wilkins, our Bloomberg government reporter in Washington, for the politics of the report. Emily, walk us through it. This is clearly a very heavily watched jobs report on Wall Street, but I'd like to hear the Washington take.
Well, Creedy, I mean, you're looking at that unemployment number. It is expected to tick down a little bit to 3.5%. That's going to give President Joe Biden and the Democrats a chance to say, hey, look, we're getting America back to where it was pre-pandemic, pre-COVID. That's certainly something that the Biden administration wants to tout. But they do have that continuing problem with inflation. We are expecting to see wage growth, but not really keep up with that continuing sky-high price of goods, services, and gas prices right now. That's what's going to really hurt President Joe Biden and Democrats in November, are those high inflation prices. And obviously the Fed is focused on trying to get those back down, trying to even things out. But right now you really have seen Democrats rely heavily on those unemployment numbers, trying to make their case that they have done what is needed for the economy during this pandemic.
380,000 then expected on the jobs created and an unemployment rate of 3.5%. We'll watch for those numbers. Emily, thank you for the political take. Emily Wilkins of Bloomberg Government there in Washington. And don't miss our interview with the U.S. Labor Secretary, Marty Walsh. That's a conversation that follows the jobs report. That's at 9:30 a.m. in New York, 2:30 p.m. in London. Now over to the European story. With inflation rising and the outlook for the European economy clouded by the war in Ukraine, top EU policymakers have been gathering today at a special seminar in Salzburg to discuss the continent's policy response. Bloomberg's Maria Tadeo spoke to the EU budget chief in Salzburg this morning.
I'm confident that there will not be any kind of recession and even not stagflation, because there is such a strong economy. I mean, if you look at the labor market in Europe, we are lack of labor forces, etc. So I think we have full order books. We face problems in the supply chain, in the global supply chain. That's an issue, and of course, the war is affecting us.
Maria joins us now from Salzburg after conducting that interview a little earlier. Maria, what is the biggest policy issue then that European officials gathered behind you are talking about?
Yes, Anna, and this is all about inflation. And of course, we know that European price surge is really now affecting pretty much everything in the continent. And this puts the European Central Bank in a difficult position. They have to show that they can get a hold of this. And remember, in this side of the world, there isn't a dual mandate. For the ECB, it's about hitting that target of below but close to 2%. And in some countries in the EU, that now triples that target. So, of course, there is now growing pressure for this move to happen. Remember, up until now, Christine Lagarde had really guided the market to this end of QE in June, then potentially this rate hike in July. I think it is very clear now that the ECB will have to hike. The question is just how fast. And of course, the other big implication for this is what's the impact on the growth picture. And of course, the commissioner there says, I'm confident that we can avoid this recession. But Anna, I can tell you that behind the scenes, there are concerns and there are worries about it. The European Union is very exposed to the Russian story, and we haven't seen the full impact of those sanctions, and we haven't seen the end of those sanctions, by the way. So yes, there are concerns behind the scenes, perhaps quietly, but there are concerns about that recession, even stagflation. I mean, Fabio Panetta of the ECB, he says it out loud. In my opinion, we're already de facto in a stagflation scenario. And just very briefly, Anna, of course, a lot of this will depend on the war in Russia, and for the time being, we're not seeing anything that would put an end to this. There is no ceasefire. The peace talks are completely over for the time being, and over the past 48 hours, we've seen Vladimir Putin really double down on the city of Mariupol, hoping perhaps to have this big parade on May 9th, celebrating potentially what he will pitch to the Russian people as a victory over fascist Ukraine and the dark forces of the West. Of course, Ukraine will deny all of this.
Yeah, so a rate hike on the table for the ECB potentially, but the complexities of the geopolitics. Maria today on the ground in Salzburg, thank you. Talking of geopolitics, China ordering central government agencies and state-backed corporations to replace foreign-branded personal computers, think US computers, with domestic alternatives within 2 years. The campaign would kick out at least 50 million foreign-made PCs. Bloomberg's Enda Current joins us from Hong Kong. Enda, what do we know about this? When I was in China, there was a move to reduce the reliance on Microsoft and some of the hardware, some of the computers from the US. I remember speaking to local government officials. They say, well, we'd like to do it, but quite frankly, our kit is not up to scratch. What's changed?
Well, that's right, Tom. It appears to be an aggressive acceleration of that push for China to engender its own self-reliance and to cut its reliance in particular on technology and hardware from trading rivals. And a lot of that comes from the vulnerabilities China has suffered in recent years with the US and others targeting national champions like Huawei and the rest. And of course, China also has its own national security concerns, and that's why it wants to bring a lot of this in-house. So it seems to be an acceleration or a speeding up of that policy attack that you have mentioned. They have in recent years been pushing towards more self-reliance, and now we seem to be getting some numbers on that. And as you mentioned, it could be around 50 million personal PCs being impacted by this directive from the central government. That obviously will impact foreign manufacturers of laptops and PCs, but of course it will boost China's own manufacturers too.
Bloomberg's Enda Curran, we thank you so much for that report from Asia. Let's take a look at some of the stocks moving in pre-market trading. Of course, here in the United States, Peloton shares declining after a report of a potential stake sale. 15 to 20% is on the table. And of course, you are seeing shares drop on that report. What's interesting here is this is coming off of the back of simply this major pandemic boom in some of those growthier names, Peloton, Zoom, etc. The ones that were really doing well at that stay-at-home era now starting to really lose a lot of that cash flow, lose a lot of that business and investment bid. So what other option is there but to take it private? At least that is the thinking for some of these names. And you can really see it weighing on the stock. Like I said, down 1.5%. Let's take a look at Tesla shares rising a little bit in the green here. Oh, well, down now, but it was in the green. This comes after it said to boost production in a Shanghai plant in mid-May. Now, the reason you are seeing a little bit of volatility in Tesla shares because on the one hand, they're going to be meeting some of those or pushing to meet some of those growth deliveries and growth delivery numbers. The really big targets that they had for Shanghai and their plant specifically quickly. But now, as we talk about COVID lockdowns, extended restrictions in Beijing as well, what is the likelihood of them actually accomplishing that? So that's why as you see these kind of new targets from Tesla, you do see some volatility. So of course, we are going to keep an eye on those shares. Tesla shares about flat trading right now, but of course, anything can change once the stock market opens. Let's take another look at Fubo TV, another downside stock, down 15%, reporting sales that trailed estimates. Remember, Fubo TV is a major streaming platform for a lot of sports networks. So if we're comparing this to the likes of Netflix, Disney, CNN Plus, for example, Fubo TV really coming under some pressure to really keep that subscriber base up, Anna. And this is going to be a really important conversation as we talk about what the future of media and streaming specifically is.
Yep, a lot of competition for your time. Now, coming up on this program, then we'll talk about the market sell-off. Chrissy, Matt Maley joins us, Militae-backed chief market strategist. Great voice to speak to on a day like today, following yesterday. And Elon Musk's right-hand man, who does everything from lining up Twitter deal financing to digging up dirt on adversaries, apparently. Read more in today's Big Take story by typing NI Big Take into the terminal. This is Bloomberg.
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. And the place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
Earnings season is here.
A moment of multiple crises.
Bloomberg is fastest with the numbers and analysis.
You do have some good news and bad news.
It's a good time to own volatility.
Bloomberg, the fastest numbers and analysis you trust.
This is Bloomberg Surveillance Early Edition. I'm Kriti Gupta in New York with Anna Edwards and Tom McKenzie in London. Matt Miller and Kaylee Lyons are off. Now, we are coming off of a day of a pretty brutal sell-off, a 5% decline in the NASDAQ, the biggest going back to September 2020, that tech wreck ahead of the 2020 U.S. presidential election. This is important because it's not just the stock market we're seeing sell-off, we're seeing the bond market sell-off as well. And you can see when both are moving to the downside, where are people putting their money? But I think the more important question is, what is the precedent? You haven't actually seen this going back to 1994. So Lynn Thomason, Bloomberg Markets editor, she joins us now. Lynn, I wanted to pose this question to you. Why are we seeing everything sell off? Where are people putting their money?
Absolutely. I mean, I think, as one investor put it yesterday, you saw investors really starting to throw in the towel. And I think there's a sense of fear that inflation is going up, interest rates are going up, and that's really a bad mix for stocks and bonds. And, even things like Bitcoin, gold, everything is just kind of heading down en masse. And, investors are talking about cash really being the place to be.
cash being the place to be, commodities still in, or is that in question because of concerns around growth?
Yeah, and also the stronger dollar. I mean, the stronger dollar is also bad for commodities. And, you know, I think, but clearly, you know, with inflation going up, commodities are still going to be an area where people are looking at.
Yeah, certainly as an inflation hedge, a lot of people talk about it. One of my favourite lines from our Bloomberg News colleague, in markets there's turbulence, then there's whatever you call the last 2 days, which I think pretty much sums things up. Lynn, thanks very much. Bloomberg's Lynn Thomason with us to talk about the market. And for more market analysis, check out MLI Vigo on your terminal. This is Bloomberg.
Stories about what they call black soot caused by the manufacturing and consumption of these fuel products in the illegal refineries.
Oil theft, known as bunkering, and the refining of its spoils is worsening the damage from decades of fossil fuel exploitation, creating one of the world's most severe ecological disasters.
Our sacred forests, our homes, have to give way to oil wells, and no one gets much benefit.
Imagine a resident of Port Harcourt who inhales this soot every second in 24 hours, 7 days a week, 30 days in the month, and for years now. We are dying slowly but surely, and our lifespan is reducing every day.
Lots happening on Wall Street.
It's the basic law of economics.
It validated what the market was already pricing.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
It's a challenging dynamic.
We could continue to see that kind of strength.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
Crypto, you have a world of young people that want their own financial system and their own culture. And it is very powerful, and I'm a big believer in it.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Welcome back. Now keeping you up to date with news from around the world. Here is the first word. In China, top leaders have warned against questioning President Xi Jinping's COVID-0 strategy. The Politburo struck a more defensive tone as pressure builds to relax the restrictions and protect the economy. China's economic activity contracted sharply last month. On Wall Street, dealmakers may see their bonuses for 2022 drop by as much as 40%. Their problem, a slowdown in IPOs and underwriting. That's according to the compensation consulting firm Johnson Associates. Meanwhile, traders could see increases of as much as 20%. Plenty more coming up on these markets. Stay with us. This is Bloomberg.
know that it's highly transmissible. We know that 2 doses of vaccines, Pfizer vaccine specifically, neutralize the virus, but not as efficiently, because various studies showing that reduction up to 40-fold, meaning that a 3rd dose is a must for it to successfully neutralize the variant. What we don't know is still that what are the effects of mix and matching between vaccines, and what are the capabilities of antibodies produced from this mix and matching in neutralizing Omicron. Because as we know, many parts of the world use different types of vaccines. And that would be a great data to look at. It will be also great to look at, because majority of the studies done uses a small sample number, and most of the time when you translate it to real world, the data changes. So it will be really good to look at large-scale data of the ability of antibodies from vaccines to neutralize this variant. Grateful here today that the virus, Omicron variant, still uses ACE2 receptor as its main entry. It means that all of the vaccines which are designed with spike in mind still works. Imagine if it uses a different receptor other than ACE2. None of the vaccines would work today. So I think that is the best news that we got from all these studies which came recently, the past couple of days.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
This is Bloomberg Surveillance Early Edition. Here's what you need to know. Global stocks and bonds falling after the major sell-off on Wall Street. Investors are worried about inflation, higher interest rates, and the risk of recession. The U.S. jobs report is out later today. There's concern that the falling jobless rate and rising wages may lead the Fed to be more aggressive with rate hikes. And China's moving to eradicate key overseas technology. Beijing orders central government agencies and state-backed operations to get rid of foreign personal computers. The move could result in 50 million foreign PCs being dumped. I'm Anna Edwards with Tom McKenzie here in London and with Kriti Gupta over in New York. Kaylee Lyons and Matt Miller are off today. And Kriti, we're still living with the after effects then of the sell-off that we saw on Wall Street yesterday.
Yeah, we really are. You are still seeing that perhaps a little bit of a risk-off sentiment in futures right now. And this is really important as we simply talk about what the actual trade is. I mean, this is significant because if we're not hopping into stocks, you're not hopping into bonds, where is the money going? We've talked about dollar strength a lot, but it's kind of that sentiment that you're starting to see continue into today's trade. So futures down about 1.6%, so already seeing that conviction selling. But is it actually panic selling? We're going to address that later. We also see the 10-year yield up 3 basis points. Remember, this follows a 16 basis point move yesterday. So that volatility, not just isolated in stocks, it's in the bond market as well. You are also seeing a little bit marginal stronger dollar following those interest rate differentials. But crude is where you're seeing a lot of the action, up about 2%. A lot of this has to do with the expectation of the EU barreling ahead with that Russian sanctions ban. The quirks of it are something to really get to know. We're going to talk about that in a little bit as well. And Bitcoin down 0.4%. So if you're looking for a risk-off sentiment, you are finding it across all asset classes. Let's get to some of the individual pre-market movers, though, because it's not just a macro sell-off. You are seeing some micro drivers as well. I want to start off with Peloton here. Shares declining after a report of a potential stock sale, 15 to 20%, a potentially minority stake. This is still according to reports. This discussion's still in progress, but this is important to keep in mind because this is coming off a major sell-off in some of those growthier names that did so well at the stay-at-home era. Peloton, really a key kind of a case study for that, if we will. Tesla's going to be another one that we want to keep an eye on. This morning, Anna, it was actually up over 1%, and then it has paired some of those gains. Tesla, this comes after saying it's going to boost its production in a Shanghai plant in mid-May, but once again, square that ambition with the growth concerns out of China, and you do see some volatility in the stock. And I'm going to end here with Fubo TV reporting sales that trailed estimates. It comes back down, Anna, to the earnings that come from streaming companies. We heard from Netflix, we heard from CNN Plus, we heard from Warner Brothers as well. How many people are actually invested in the streaming space and in the success of the streaming networks?
Yeah, Chrissy, you talked about the macro and the micro factors influencing the US market. That's certainly clear here in Europe as well. From a macro perspective, the big picture story, we're down by 1.5% on European stocks, picking up from negativity on Wall Street yesterday. The futures picture looks a little weaker for the US as well. That's working its way into the sentiment. But we've also had some gloomy earnings stories, and that is weighing on things as well. We're watching the pound. We're also watching the euro. Just in the last couple of days, we've seen some slightly more dovish voices taking center stage, switching the focus to growth instead of inflation for just a moment. But today we saw more hawkish voices coming through in the shape of the Bank of France. And as a result, we saw some recovery coming through in the euro. 105 regained as the handle on the single currency, 105.64, up 0.2%. To the micro, and some of those stories that disappointed just a little bit, we're down by 5.2%, more than a bit there, for the Adidas share price. This as this company cites concerns around their business in China, and that was something that weighed on their suppliers in the Asia region. IAG, the aviation business, it owns British Airways and also Iberia, that stock down by 7.3%. Of course, it was about the earnings, the backward-looking story, the fact that the Omicron recovery had been maybe slower than they'd anticipated, and so the numbers disappointed, essentially, the market's expectations. But perhaps we're also nervous about higher energy prices, because energy stocks are moving higher today, and Chrissy showed us the higher oil price that we're seeing in these markets. Quick word on Russia. Next week, the focus is really going to be on the inflation story out of Russia, and there we will start to ask questions about just how tough the sanctions environment has been, how much tougher it can get, and what impact, what pain, effectively, that is causing for the Russian economy. Chrissy?
Yeah, a lot to watch, Anna. When we talk about pain in the Russian economy, let's also talk about pain in the markets here, specifically the stock market sell-off we saw yesterday. Chris Murphy, the co-head of derivative strategy at Susquehanna, he spoke to me yesterday about an interesting piece of the sell-off. What exactly is driving it? Take a listen.
Sure, investors are hedging, but you also have to remember, we're hearing a lot about how degrossed everything is, and the volumes in general are not that high. It kind of feels, a little bit more like a buyer's strike as opposed to, investors that have all these positions on that are panicking, putting on big hedges for more downside.
Well, joining us now to dig more into that is Matt Maley, Chief Market Strategist at Miller Tabak. Matt, thank you so much for joining us. I have to really dive into this because it's important to see who is selling and why they're selling. As we just heard from Chris Murphy, this idea that this isn't panic selling. Your take?
Yeah, I mean, we have seen, a pickup in volume a little bit, but not much more than we saw, on the big up days either. I mean, we saw earlier in this week or even, 2 days ago. But the thing is when you get this, panic, there's a difference between panic selling and forced selling. Panic selling is people say, oh gosh, get me out at any price. Forced selling, of course, is when you get margin calls and such, where some of these leveraged players have no choice, but they have to sell at any price. It doesn't matter if they think it's cheap or oversold; they just have to sell. The good news is that at some point, when you get kind of that forced selling, those margin calls, you do get a kind of a washout move, a capitulation move. I don't know that we've really seen that yet, but it seems like we're getting close to one, and we'll see what happens. This weekend is going to be very important because a lot of people have lost a lot of money. You worry about this, some big hedge fund going to blow up. We're going to have, they're going to have to, unravel a bunch of positions. That could be a fear, but we seem to be getting close to something that will at least give us a bottom, a near-term bottom. But longer term, we still have this issue of inflation, so we really have to be worried about that.
Okay, so Matt, you're watching the next few days and whether this, the economic financials in terms of the conditions lead to any unusual events. How do you want to be hedging with this environment? There's been a call to hedge within equities, within areas like healthcare. Does that align with your views?
Yeah, I mean, I've been cautious since the beginning of the year, and I've been saying that people should be raising cash on any kind of bounces, and that's been a good idea. I think it will continue to be that way. We look at hard assets. What does well in inflation? Hard assets, and the oil sector, continues to do well. We want to stay with that, and I do think that the healthcare sector is fine too. But anything with hard assets, and it's interesting. Everybody's talking about housing bubbles and such, but one of the good things that real estate was a good hedge in the 1970s because that was a very similar time, even though people say it's not as bad as the 1970s, but that was a supply-driven bout of inflation, and because that was the OPEC oil embargo back then, and so it's very similar in that way, and those are the kinds that we worry about cause stagflation. So hard assets are really one you look at. Also in the agricultural area, like Archer Daniels, Midland, stocks like that can be real places where you can hide for now.
We were speaking to Stephen Major of HSBC a couple of hours ago. He said he thinks 3% on the 10-year is now the floor for the yield. What is the read across to the tech sector? Does that just keep the cap on any potential gains when you do get a dip like you saw in the last 24 hours or so?
Yeah, I'm afraid it does. You know, it is high enough to create problems there. I mean, one of the things that we forget is that, you know, interest rates have gone up, and even if they're you know, still relatively low on a historical basis, they're still at a level that has to bring what we consider fair valuations down. And a lot of these big cap tech names we've been so used to, with all the global central bank largesse that we've gotten from them for a dozen years now, that's disappeared. And so with interest rates higher, those valuations have to come down, and it's just going to be a while before those big cap tech names really come back into a rally in a big way.
And Matt, on tech, when would be a good time to think about getting back in? I was talking to one tech analyst, a tech share owner earlier on today, who was bemoaning the fact that the market just sells off everything, even when he was arguing that there are some parts of the tech space that do have some pricing power, and you saw that in some areas of the earnings.
Yeah, that's the one thing is, you know, we've heard all year, and it's true. It's a stock picker's market, and some of these stocks are getting really knocked down. And the ones that, you know, you look at a stock like Nvidia, Advanced Micro Devices. I mean, you know, the stock is well below. It got hit really hard yesterday. These are some of the names that you know, do have pricing power. Do have, you know. I guess my point is, my concerns are because of valuation levels, not because of their companies and their prospects. This is not, you know, this is not 1999, 2000. All over again. These are good companies. They just got ahead of themselves. So, like, you know, the difference between a stock and a company, and the companies are really good. The ones I just mentioned, their stocks are just a little too far. And as we move through the next few days, there are going to be some great buying opportunities.
Okay, and looking ahead, we've got the non-farm payrolls number coming in a few hours, Matt. We've got that jobs report hitting. Is there anything that could be contained within the jobs report that would be positive for risk assets, or does it all lead to higher interest rates?
Well, I mean, the one thing is, some people say, geez, hopefully it's a lower number, and therefore people will say, oh, geez, that's going to cause the Fed to pull back. That's fine, but as Fed Chairman Powell said this week, I mean, he flat out said, hey, listen, we can only control the demand side of things. We can't control the supply side of things. And that raises the specter of stagflation even higher. And if we do get a weaker number, does that tell us that, geez, the economy is getting weaker, so therefore inflation is going to get weaker? Or does it really tell us that it's supply-driven inflation, and therefore we're going to have stagflation? So I'm a little bit worried that this number is not going to be all that helpful. But again, a lot of this selling has not been fundamentally based. It's been because of margin calls and other forced selling issues. Hopefully that will provide for a bottom, a near-term bottom, but longer term, I still think people should be raising cash on any kind of rallies. And then later in the year, you're going to have an unbelievable buying opportunity, and you know, ones that we've seen in the past that have been followed by, you know, multi-year bull markets.
Matt, thank you very much. Thanks for your thoughts. Matt Maley, Militarbeck, Chief Market Strategist. Coming up on the Open, in fact, so a little bit later on in programming, Mohamed El-Erian, Gramercy Funds Management Chair and Bloomberg Opinion columnist, of course, ex of PIMCO many years ago now. That's at 9:30 a.m. in New York, 2:30 p.m. in London. This is Bloomberg.
Exclusive interviews with the most influential figures in finance. Lloyd Blankfein.
Deflation is a terrible thing. Inflation you could tolerate.
Kathy Wood.
Tesla will be in the pole position to dominate.
Jeremy Grantham.
We've had a very, very abnormal honeymoon Goldilocks period.
First available on the Bloomberg Terminal, then on Bloomberg Television and Bloomberg.com. Front Row, the best seats in the house for business's greatest minds.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
This is Bloomberg Surveillance Early Edition. I'm Anna Edwards with Tom McKenzie in London and Kriti Gupta in New York. Matt Miller and Kaylee Lyons are off today. Now, there's concern that today's US jobs report may complicate the Fed's inflation fight. The report is likely to show employers added another 380,000 jobs in the month of April, but intense labor demand risks sparking even faster wage growth at a time when the Fed is already trying to tamp down the highest inflation in 4 decades. Simon Kennedy, Bloomberg Executive Editor for Economics, joins us now here on set in London to talk us through what to expect. And Simon, it's felt for quite a long time like the market's attention hasn't really been on jobs, it's been on inflation. But of course, with the tightness of the labour market, they are really linked.
Absolutely, and you're going to see a wave of data today. It could go either way, but certainly, historically, you might look at the payrolls report, and then after that unit labour cost data yesterday, people are tuning into those average wage gains. Is there a risk of a wage price spiral? You know, we like higher wages, but central bankers, and we saw this with the Bank of England yesterday, sometimes edgy about those higher wages because they drive prices up, and then you're into a spiral that's very hard to restrain. So a lot of eyes will both be on the unemployment rate, which could drop back to a pre-pandemic low of about 3.5%, but also that average wage data is critical for the Fed's outlook.
Yeah, 3.5% is remarkable, isn't it? Are we at the point where that labour tightness is starting to draw additional participants into the workforce? Are we seeing any evidence of that?
So we're seeing it slightly at the margins, but there's this conversation about the Great Resignation and people staying out. Certainly there's labour shortages in certain key areas, the same again in the UK. So the hope of the central bankers is that they can pull more people back in, that draw of higher wages, perhaps also the kind of the push of paying more at the checkout will pull people back into the workforce. But again, that labour participation rate, another key number. Previously, we'd first Friday of every month, we'd look at the payrolls number, we'd see it go up, we'd see it go down. The report is far more meaty, far more intensively looked at, not just the headline, but beneath the surface.
So the detail matters. Kriti, jump in.
Well, I'm curious about the real wages as well. I mean, Simon's been talking about this. This is important as we talk about not just inflation, but the inflation per income class. For a while, the lowest income class actually had the highest real wages, and I'm curious if that trend is going to change.
Well, we'll have to see, but that's a critical part of the debate, and it's also kind of an unfair for the people who are seeing wages go up aggressively for the first time in years. It's kind of unfair to then read that this is being perceived by central bankers as a bad thing. But the more people who can be drawn into the labour force, remember that was the aim of the Federal Reserve. They changed their framework coming up to 2 years ago in the aim of running the economy hotter. And now they seem to be, if not regretting it, then moving faster. Certainly even Jay Powell talking recently about, with hindsight, they might have moved for a little faster. And Diane Swank, economist who was on Bloomberg Television yesterday, pointing out that unemployment affects a few people compared to inflation, which affects every person. So that's another dilemma for the central bankers.
And Simon, what did we take away from the Bank of England this week? There's almost a sense that this is a central bank that's been hiking for a while now, so not late to this perhaps, or at least they're earlier than some other central banks. Do you get a sense that they're pivoting on that tightrope? We talked a lot about how there's a tightrope to walk along for the Bank of England, and it's been all about inflation, and now increasingly it is about concerns over growth.
Well, if a tightrope can narrow, it did yesterday at the Bank of England. That is a brutal assessment of the economic outlook from probably any central bank. I think every central bank, if honesty is the best policy, then the Bank of England pursued that yesterday. But within the bank, you have differences. You had people voting for 50. You have people looking to the outlook and saying, no, we're probably done with raising rates. So you got this 50 camp at the most hawkish. They might want to get that extra 20. People who were 25 going, okay, maybe we go again. And then the third group of two policymakers saying they don't really see more hikes. So that's an incredibly difficult position for the Bank of England, perhaps more so even than the Fed. They were pretty honest in their assessment, 10% inflation. They didn't use the recession word, but they see a contracting economy next year. Who'd be a Bank of England policymaker?
Yeah, tough gig. Yeah, that 10% inflation, a lot reliant on where energy prices go and the way that, because of the way that the energy cap works here in the UK. So interesting detail there. Simon, thank you very much. Bloomberg's Simon Kennedy with the latest on various macroeconomic themes, the central banking lessons of the week and the data to come. Coming up later, sticking with the jobs report, in fact, we'll get a view on the jobs report from the US Labour Secretary, Marty Walsh. That's at 9:30 a.m. in New York, 2:30 p.m. in London. This is Bloomberg.
Energy prices and a short supply of key chemicals that produce synthetic fertilisers are sending pig, cow and horse manure prices soaring. Even human waste is in demand as farmers hunt for alternatives. Fertiliser helps increase crop yields.
You can see how much moisture is held into this. It's a lot of organic material into the compost, so it breaks down. The manure and the straw breaks down into a friable mix that can be mixed into your soil in the ground and for growing a whole range of different vegetables. Holds the nutrients in, holds the water in, and it really increases the kind of biodynamic profile of the soil.
The recent price spike could mean more farmers going organic for the long term.
Isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
This is Bloomberg Surveillance Early Edition. I'm Kriti Gupta in New York with Anna Edwards and Tom McKenzie in London. Matt Miller and Kaylee Lines are off. Tom Keene joins us now on this Jobs Friday. Tom, your single best chart today.
Well, it's, Kriti, it's a Jobs Friday, but I'm sorry the markets have intruded, and the markets continue this morning with some really interesting dynamics. I'm looking at yuan, Turkish lira unravels, and sterling had a really ugly 3 a.m. hour in New York. What I'd look at, though, is the equity markets. This is a chart we've had out through all of the pandemic. It's the correction bear market chart. In yellow, a 10% correction. In red, a bear market on a log axis, which means that the proportions are equivalent. What is different this time, Kriti, is the length it's taken to get here. From the peak of a number of months ago, it's taken much longer to get to a Dow Jones correction level. Short and sharp has become longer and prolonged.
And Tom, you've got Randy Krosner coming on to help contextualize where things stand with the Fed on this jobs day.
Yeah, he's always with us, but it's a really perfect day to talk to Tom, to talk to him, and that It's about the financial system and how it folds into the jobs report and what that means, not just for the Fed, but for the labor economies of the United Kingdom and Europe as well, with the ECB coming up. Really looking forward to speaking to Jeffrey Rosenberg of BlackRock as well.
Okay, fantastic stuff. Tom Keene, of course, co-anchor of Bloomberg Surveillance. Thank you. And Bloomberg has learned, switching focus to what's happening in sport, that a deal regarding the sale of Chelsea Football Club may possibly be announced today. That would end a 2-month process after Roman Abramovich was sanctioned, of course, by the UK government following Russia's invasion of Ukraine. Let's get more then with Bloomberg's Laura Wright. Laura, who is the new likely owner? What do we know about the potential deal?
Well, Tom, the Americans are coming. The new expected owner is Todd Boehly, who is leading the consortium, who are said to be the front runners. As you mentioned, we may get news today. He's formerly president at Guggenheim. He founded Elridge, and he's an individual that has experience owning sports teams. He's the co-owner of the LA Dodgers, a US baseball team. There's a sense of urgency with this deal to go through because the special operating license that the government granted Chelsea expires on May the 31st, and the government have signaled little appetite in order to extend that license. It's been a competitive bidding process over the last 2 months, and if successful, Boehly's consortium will have fought off stiff competition from other wealthy US investors, including the Bain Capital co-chairman and also the Apollo Global Management co-founder. In terms of American influence in the Premier League right now, 8 of 20 teams have some influence. 3 teams are wholly owned by Americans. That includes Man United, Arsenal and Liverpool.
So the Americans are coming and are already here, it would seem, in UK sport and indeed in some football clubs in other parts of Europe as well. Now, there have been reports, Laura, that this could all get held up by conditions around a loan that Roman Abramovich did or did not ask to be paid back. What's the latest on that?
Well, basically, during his tenure as the owner of Chelsea, Roman Abramovich lent the club £1.5 billion. He was sanctioned on March the 10th by the UK government shortly after the sale was announced. Initially, he said, don't worry about the money, it's okay. Then reports emerged earlier this week that bidders were asked to front up an extra £1.5 billion. That would be a problem because currently Roman Abramovich is not allowed to receive a single penny in the UK. Then last night, a statement came from Abramovich's spokesperson refuting that he wanted the loan repaid, refuting that he'd increased the price of the club last minute. But look, this is in the context of a Chelsea owner that's won 5 Premier League titles, 5 FA Cup titles and 2 Champions League titles. And he says, look, I just want the best for the club going forward, and he will still have overall say over who that new owner will be.
Bloomberg's Laura Wright bringing us all things football, as I'm told it's called, or soccer for our American audience. Thank you so much.
Definitely football.
We'll have that discussion at another story.
Just on this story.
Fair enough. I concede. Laura Wright, thank you so much, as always. Let's get a quick check on these markets. Weaker futures already, a real connection here, or I should say a continuation, Anna, of what you're seeing from yesterday's price action.
Yeah, absolutely. And the session here in Europe, a lot weaker actually than the futures picture had led us to believe it would be. And some of that is to do with yesterday and the sell-off in New York, but also to do with the earnings stories we've had here in Europe today, which have not been fantastic. Also worth noting, a little bit of strength returning to the euro after a day where we were hearing a lot of dovish voices around the euro critty. Now some more hawkish ones getting through, and the euro gains just a touch as we get towards the start of
and we'll keep an eye on that dollar, of course, as we hear about the U.S. jobs report coming shortly. For now, that's it for Early Edition. Surveillance is ahead with Tom, John, and Lisa. Stick with us. This is Bloomberg.
companies now, they're getting hundreds, maybe even thousands of applications. So software has come in to automate the process.
You want to write your resume for robots, not for humans. The only job your resume has is to be comprehensible to the software that is reading it, because that software or robot is going to decide whether or not a human ever gets their eyes on it.
These things are programmed by a certain segment of the population that might not be totally inclusive or not be fully aware.
Concerns about how this technology could exacerbate discrimination. For the FTC, I think foremost, the FTC needs to be making sure that we're fully understanding this technology.
We don't trust companies to self-regulate when it comes to pollution. We don't trust them to self-regulate when it comes to workplace comp. Why on earth would we trust them to self-regulate AI?
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
These are three central banks, all with slightly different challenges.
Right now, we're going through a hangover in world capital markets.
The fundamentals is that liquidity is continuing to drain.
They need to move on inflation. They need to move on rates.
I think we're going to stay on the edge of our seats until we see that core inflation move down below 3%.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
Live from New York City for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance on TV and radio alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Ferro. Equity futures down about 0.2% on this Payrolls Friday. TK, we have to start with the carnage of the last 24 hours.
Yeah, it's going to be really odd Payrolls Friday. This is an incredibly important report. Michael McKee is out at the Hoover Institute. He'll join us here in the very early California morning. John, I'm telling you, the market's extraordinary, and I'm going to say this as clear as I can. The difference this time is the previous pandemic corrections we've had were short and sharp, and it's taken a long time from the peaks to get to. And in case of the Dow, a 10% correction. The drawdown on SPX is 16%. This is lengthened. It's prolonged.
We have to pick over the damage, Tom, the destruction already done. These stats from Bank of America this morning, 49% of the NASDAQ more than 50% below their 52-week highs. 77% of the index, Tom, already in a bear market.
Yeah, well, this is always going to be the case. The dispersion, the distribution, rather, that you see among any given index. And John, I take your point, particularly here, the Standard & Poor's 500 is much more indicative than the Dow Jones Industrial Average. But I would correlate it over and say, okay, what happened yesterday? Was it Governor Bailey? Was it something else? And to me, it was the x-axis of the inflation guess forward. It shifted yesterday, and equities took it on the chin.
Bramo, what happened yesterday? Some people might ask, well, what happened Wednesday? Let's talk about that a little bit more.
Look, you could talk about the intraday moves, the idea of somebody unwinding or somebody getting in there, or some kind of particular trade being put on. The lack of conviction right now and the amount of volatility, however, and the fact that we're not seeing dip buying is telling. I think it's interesting that Bank of America's Michael Hartnett has come out, sees more outflows, sees more potential losses ahead, does not see a technical bottom. And Jim Reed of Deutsche Bank came out and said the only conclusion you can draw is that the market quickly realized the Fed really aren't going to be able to control this cycle very easily.
380K, the number for a little bit later this morning, Lisa. We're going to talk about payrolls this morning.
I don't know. I think that we're going to try. The issue is, why does it matter, right? At what point is it going to become actually a tail risk for the Fed?
We'll catch up with Jeff Yu in just a moment. Let's kick things off for you this Friday morning, and good morning. A little bit of calm after the carnage of yesterday. We are negative negative just a third of 1% on the S&P. On the Nasdaq 100, down another 0.4%. Yields are higher by 4 basis points every single time, Tom. Someone comes out and says, "Yep, that was it. We're done." Yields break out again. Close to 3.1%.
It's very linear. It's very, just as you say, there's an ebb, it's done, it's over, and then you move on as well. I'm getting the most value, John, triangulating foreign exchange and some of the nuances there. And today has a little bit of an EM follow-on. When was the last time we talked about Turkish lira or renminbi giving way to 6.70 earlier this morning? By the way, is sterling an EM currency this morning?
I think we've got an EM
sure.
central bank on our hands, Tom. We've been talking about that for a number of years over in the city of London. Lisa, an ECB official with plenty of things to say this morning. Euro dollar 105.74.
Basically saying it would be appropriate to get to a positive rate later this year. This is an influential member of the ECB Governing Council, the head of the Bank of France. How much this has become really one of the main drivers of the increase in yields on the short term and the long term, because it is global. We keep remembering that, but this is unprecedented. At 8:30 a.m., this is the big moment. This was supposed to be the big moment anyway. The April jobs report. The estimates range from 300 to north of 500,000. How much does that matter? How much does it matter that the U.S. unemployment rate is expected to fall to the lowest going back to the early 1960s, at a time when Fed Chair Jay Powell says that he is worried about how overheated this market is? Joining you, John Farrow, U.S. Labor Secretary Marty Walsh is joining at 9:45 a.m. How do they spin this? Is it a good thing or is it a bad thing for the labor market to be this tight? Today, Fed speakers line up and they all unleash. Minneapolis Fed President Neil Kashkari, Atlanta Fed President Raphael Bostic, St. Louis Fed President Jim Bullard. I'm very interested to hear what he has to say, as well as San Francisco President Mary Daly. How much do they push back against some of the complacency that we saw on Wednesday that was quickly overturned yesterday in markets? How much do they talk about the need to tighten faster in the face of increasing inflationary headwinds? And ex-Vice Chair Rich Clarida yesterday, just want to point this out, will come out and talk about, or he did come out and talked about how the concern for higher rates, the Fed funds rate will believe ultimately need to be raised well into restrictive territory by at least a percentage point above the estimated nominal neutral rate of 2.5%. The reason why I brought that up, actually, John, and it wasn't here, but former head of the Governing Council, Randy Quarles, is going to be speaking to our own Michael McKee later today. And I want to hear from former Fed officials, because those might be the most honest in this discussion.
He's already told us what he thinks, hasn't he?
Yes.
Governor Quarles earlier this week, Tom, essentially came out, and thank you, Lisa, by the way, and said the reason they waited was because they did not have the clarity on Fed leadership. That's why they waited, and they should have got on top of it in September. That was Governor Quarles this week. I'm so much looking forward to that conversation with Mike a little bit later, because at the moment, Tom, the only real transparency you get right now is from the former officials. With the exception of maybe a couple of Fed presidents, the former officials are out there and they are swinging hard.
That is a big change. They are swinging hard. It's a big change. What I would say, John, you've been out front in this. I'm like, do I want to do Days of Our Lives or General Hospital on the Federal Reserve? The answer is I don't. But I'm going to suggest to you that all of this will be in books written 3, 4, or 5 years from now.
Are you suggesting this is a soap opera at the moment, Tom?
I would suggest
just a little bit
that these are sensitivities which you as a journalist are correct to bring up, but they cause discomfort.
Let's kick things off with Jeff Few. No discomfort
Always
here.
Too sensitive,
our senior EMEA market strategist at BNY Mellon. Jeff, what is easier to explain, yesterday's price action or Wednesday's?
Well, I think yesterday is actually quite easy to explain. You know, two things really. One, the markets are realizing, actually, you're not doing 75, but 50 basis points on a consecutive basis still puts the Fed out there, still puts the US out there in tightening financial conditions. And on the same day, the Bank of England has said, we are tightening into a recession. That's how bad things are going to get, right? So if the US is going to be alone out there with a strong currency, with a very hawkish central bank, then of course that's going to have a knock-on impact on broader asset classes, and we are seeing a divergence right now.
Jeff Hughes, you know, I want to go out the x-axis here. I've been doing that for, it seems like, the last 6 months. With yesterday with Governor Bailey, did the medium term become the new short term? Have we extended out our inflation guesstimates, our analysis of inflation dynamics, and changed simply out quarters?
Well, I thought Governor Bailey, just looking at his body language, he felt very uncomfortable when asked about the cost of living crisis within the UK for various reasons. But the bottom line is that you actually have a very split Bank of England right now. The emphasis seems to be on there is a significant body within the MPC who actually don't want to signal too much hawkishness. They are very worried about what the impact on the consumer is going to be. And it felt like as soon as they can stop, they will stop, right? So the BOE is a bit ahead there, but that underscores the growth risks. Going back to the US, there just aren't that many growth risks right now. The economy is booming. Today, I think, again, we'll see average hourly earnings on a monthly basis be stronger than core PCE prints or core CPI prints. That means the Fed can continue to forge ahead, and equity markets, credit markets, they are wondering what would that mean for US underlying assets.
Jeff, do you think that the Fed committed a policy error this week?
I don't think they committed a policy error. It's always after the fact where we have discussed this. But the Fed needs to decide, can the US be independent enough, and I don't want to frame this in a bad way, be closed enough, be autarkic enough, not to care about what happens to the rest of the world with the dollar, with our own transmission mechanisms. They need to make that decision. If they believe the US can be an island into itself, then they will say no policy error. But you only find out sometimes it's too late when it already is too late.
Jeff, the chairman this week essentially clarified the rate path at least through summer, through the next couple of meetings. That's clearly not sufficient to dampen the volatility. What do you think will be sufficient through the next several months to do that? What do we need?
Oh, certainly not enough, as Tom mentioned. So what kind of time horizon are we looking at right now? We need to talk about having clarity over the entire forecast horizon. That's the amount of uncertainty in place right now. So either you have clarity over the entire forecast horizon, so on a 2 to 3 year basis, or you make it very, very clear they're going to be very tactical. Every meeting is a live meeting, but it's going to be a case-by-case basis. So strip out this 50 every meeting for 3 or 4 meetings or anything like that. Take each month's data point as they go from there, and then allow markets to be tactical, because this policy markets duration mismatch right now, that really is causing a lot of pain.
Jeff, awesome to catch up with you, buddy. As always, to talk global markets. Jeff Yu there of BNY Mellon. Evercore out with this one. Powell's mistake was to strike a tone that prematurely invited the easing of financial conditions. Lisa, I know this will resonate with you. The market's mistake to rally hard without sufficient new information to warrant this, and conditions in which such a rally could not possibly be sustained.
This has been one of the main questions underlying a lot of the notes that I've been reading this morning. Basically, financial conditions can't ease, can they? I mean, honestly, if the Fed does not want to see that, so won't they come in and change their tone if financial conditions effectively ease by stocks gaining or bonds gaining? And this, to me, seems to be one of the sentiments that's that's underpinning a lot of the volatility right now.
Not just down to the Federal Reserve, we need to look to China too. Adidas came out with numbers today, Tom. Adidas, as you might say.
As I might.
The revenue to Greater China in the first quarter fell 35%. Margins are starting to become problematic because costs are rising, and they're not able to fully pass that on to the consumer. That's everything everybody's worried about at the moment, caught in one stock.
John, as simple as I can. It's a totalitarian state. They've got a different calculus than everyone else. The answer is on this lockdown. I don't have any original information on the lockdown, but his shortest path, given the party Congress this fall and the lockdown right now, is to get it over, get it done. Oil with a 114 print hours ago, and I'm sorry, the technical chart of oil screams breaking out.
Tom, you just nailed it when it comes to China. You said this fall. So if we're looking for clarification of some of the issues that are really whipping this market around, you've just said it. As far as China's concerned, you've got to wait until the end of the year.
You got to wait out. They got to get this lockdown fixed so they can get to that important party Congress to validate the Xi regime.
Tom Keene, Lisa Bramett and Jonathan Ferro. Equity futures down around about 1/3% on the S&P 500. Payrolls just around the corner. Your estimate this morning, 380K. Your headline number in our Bloomberg survey. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. There's concern that today's U.S. jobs report will show that the Federal Reserve needs to be more aggressive with rate hikes to contain inflation. The report is likely to show the unemployment rate dropping to 3.5%, whilst wages rose 5.5% over the last year. The jobs report is out at 8:30 a.m. New York time. The EU has proposed a revision to its Russian oil ban to give several countries more time to comply. Bloomberg's learned that Hungary and Slovakia would get an extra year until the end of 2024. The Czech Republic would get an exemption until June of that year. All other EU members would phase out Russian oil imports by the end of this year. And China has ordered government agencies and state-run companies to get rid of their foreign-made personal computers. It's one of Beijing's most aggressive efforts yet to eradicate overseas technology. The move could result in 50 million foreign PCs being dumped. And it is one more blow for a city whose economy has been battered by crime and the coronavirus. Boeing announced will move its headquarters from Chicago to Arlington, Virginia. That will put the company near federal government decision makers in Washington. Chicago has seen a rise in crime that's prompted billionaire Ken Griffin to say he's likely to move his $38 billion hedge fund elsewhere. And a group led by former Guggenheim president Todd Boehly is close to an agreement to buy English football club Chelsea, one of the most successful of the past 2 decades. The price is certain to be the highest ever paid for an English club. Russian billionaire Roman Abramovich put the team up for sale in March, just before he was sanctioned by the British government. Global News 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
The Indian city of Jamnagar is a money-making machine for Asia's richest man, Mukesh Ambani. His company Reliance has the world's biggest oil refinery complex here in the city. Jamnagar is also where Ambani is making his newest bet, a $10 billion investment in green energy. His ambition is closely aligned with the Indian government's plan to reach net zero emissions by 2070. But Ambani is not alone. India's second richest man, Gautam Adani, has committed $20 billion of investment over the next decade. But India's massive dependencies on fossil fuels have some environmental advocates questioning the realism and sincerity of those green ambitions and those of its 2 biggest billionaires.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
This week, April jobs are in focus.
It's a very, very good labor market for workers. The demand for labor, obviously, much stronger than the supply.
Today, Tom, John, Lisa, and Mike will bring you the data and analysis as the numbers cross the Bloomberg.
As long as the numbers hold up, the Fed is going to feel encouraged.
Then 75 in June is certainly not out of the question.
To me, the question is, are we fully employed?
The elephant is the war in Ukraine.
The April Jobs Report, today on Bloomberg Television and Radio.
Risks on the upside to inflation, but we also think that the core story here is a big real income shock to the country, and that we think is going to slow the economy down. It's going to slow demand in the economy down, and we're probably already seeing some signs of that.
That was Governor Andrew Bailey of the Bank of England sitting down with Guy Johnson, who I have to say is one of the best interviewers of policymakers across Europe. Check out that interview if you can on Bloomberg.com and on the Bloomberg terminal. Equity futures this morning, and good morning to you. Negative by about 0.4% on the S&P. On the Nasdaq 100, down 0.6%. Yields are higher by 5 basis points on a 10-year to, let's call it 3.1% at 3.0868. Euro dollar a little bit stronger here. Euro dollar 105.83. This from B of A just moments ago, cutting their Euro GDP growth forecast to 2.2% for this year, 1.5% for next year. Inflation, 7% this year, 2.9%
How do you get
next
there?
year. Tom, their base case is not a recession, but they say the buffers are small and the risks are large, and it won't stop the ECB from hiking.
The bet right now, John, is just what you said. How do you get from 7-ish down to 2.x-ish?
Tom, I think the difficulty they've got right now is they just watched what the Bank of England did yesterday. And Lisa, I imagine they're incredibly nervous that they're about to experience the same thing.
And is there any way to really avoid it? Because honestly, if they don't give an honest assessment, is the market going to do its own thing anyway?
Another ECB official saying the only way forward is to start raising interest rates, Tom. Next month, big meeting for this ECB.
And again, Michael McKee out at Stanford and the Hoover Institute. John, those will be some interesting conversations. He's dived into the land of the Fed hawks.
Is that right?
So, yeah, we'll have to see what Bullard's out there, and Claret is out there making his first appearance after his exit. And, you know, we'll have to see. Right now, a difficult conversation. There will be no other story in Washington today. All is pushed aside by the report from NBC News, followed on by other reports and explanations by the Biden administration over the character and quality of intelligence given by America to Ukraine in the sinking of a Russian ship with 500 sailors on board. Maria Tadeo is in Salzburg, Austria, and we begin with Emily Wilkins this morning in Washington. Emily, there's flat out no other topic. How does the administration respond delicately to the nuances here, the idea of NATO mutual defense, and yet we didn't cause this ship to sink, but we did provide an intelligence stream?
Well, Tom, the reporting from NBC News, which we're now seeing seconded by a number of news organizations, really sort of puts into light about where and how the U.S. is thinking about assisting Ukraine at this time. It's not quite clear exactly what the extent of U.S. intelligence was compared to the extent of Ukrainian intelligence, but it really is showing that President Biden and American officials are sort of changing their thoughts a little bit on exactly how involved they want to be with Ukraine, and shows a little less concern about potentially provoking an escalation with Russia.
Maria Tadeo, those are Neptune missiles, which is Soviet technology, I should say Russian technology that Ukraine builds, but this has to have ramifications in Brussels, in London, and dare I say in Warsaw and Salzburg as well. How will Europe react to these reports of U.S. intelligence and a new level of it, an initiative?
Well,
Well, Tom, I'm not surprised by it, because moving away from this ship and just looking at the overall picture, the Ukrainians have said this on the record multiple times. It's not just the weapons, but it's the intel that they get from Western partners that really allows them to stay competitive in this war. What they also say is that taking that intelligence and making good on it allows a country to defend itself. So they don't look at this as an attack or a counterattack. They still repeat what we get, both the weapons, the intel, the information is a way for Ukraine to protect its sovereignty. And they have said this repeatedly, by the way. When you look at the U.S. intelligence, it has been much better than the European throughout this war. They were very correct on their assessment on the war. They were correct about the timelines. And the Ukrainians have said this repeatedly, as I say, that this has been as equally important, if not more, than the weapons themselves.
Maria, is European sentiment waxing or waning when it comes to increasing aggression towards Russia, or enabling Ukraine to be increasingly aggressive, especially in light of some of the economic concerns?
Look, it depends which country. And as always, with the European Union, you talk to 27 different countries, 27 different governments. And I was just in Berlin 2 days ago, and I have to say this is the biggest economy. It has a lot of political momentum behind it. When the Germans sent a signal, everyone else follows. And I was there 2 days ago, and to me, it is very clear that the Germans have not made their mind up. They're not like the United States. They're not like the Biden administration. They really do worry about this potentially spilling over. They believe that there are a lot of risks attached to it, and they're not perhaps as facilitating as the United States has been. So when it comes to that alignment on Ukraine, the Germans are still much more cautious than the Americans. And I would say there's one key factor here. Zelensky has been very good at convincing the U.S. administration that he can win. When it comes to the Europeans, they believe that this is not about victory, but it's about a ceasefire, that should be the focus. It's not a victory, it's a ceasefire.
I'm pretty sure where you are, they recorded scenes of The Sound of Music. Did you know that? Did you know that, Maria?
I knew, and yeah, I knew this. Also, my name's Maria. Well, and by the way, the real house of Baron von Trapp is actually on the other side of the river. I wish you could see it. All of this is a true story.
Because I know where you are. I've been there. I've stood there. Maria, thank you. Of course, I know your name.
Do you know that now?
I know her name.
And Tom is now going to start singing, the Hills.
Well, that's what I was trying to encourage.
You're trying to encourage
It's a beautiful place to go. That's the Salzburg Global Seminar.
So now we've got a road trip.
I went there a long time ago. It's fantastic. Maria, thank you. Maria Tadeo, alongside Emily Wilkins. TK, do you want to sing?
Oh, no, I couldn't.
No, you're done?
I couldn't. John, when Sound of Music came out, of course, there was no other technology, and it was the birthday party movie for girls across this nation. And I would suggest the Keene household saw Sound of Music.
You got dragged to that a few times.
Like 15 times.
You sound haunted by it.
My sisters were scarred for life.
Sounds like you're scarred by it too. If you're just tuning in, carnage yesterday in the equity market. Can we call this calm? I've got no idea, because it looked like this yesterday morning too, down about a third of 1% on the S&P, Tom. On the Nasdaq 100, down 0.4.
Yeah, I had a report I had to write up yesterday, bull market strategy on this. I said, blossom of snow, may you bloom and grow forever. NASDAQ wise.
Do you want to keep going?
Bless.
You've got 30 seconds.
Bless the triple cash flow. I got to get closer to the mic on radio, folks, to do this right.
A lot of people messaged me yesterday about how much you've outperformed the market this year.
It's just stunning on a relative and absolute basis.
You mean triple leverage cash, not the singing.
Totally crushing it. No, not the singing.
Just saying.
Futures down a quarter of 1%.
You look happy to meet me.
Payroll's coming up a little bit later. Keep going, Tom.
Andrew
Hollenhorst, the city's going to join us.
Just killed that.
Andrew's looking for about 360k. The estimate in our survey is about 380. From New York, this is Bloomberg.